Earnings coming in is just another data point that people have to absorb to try and understand this narrative.
The source of the negative surprises this quarter has been, in fact, weaker margins than was anticipated.
The market is consistently underestimating the level of inflation by anywhere from 50 to 150 basis points.
The Fed has been leading the most recent push higher in global rates.
Everybody wants to channel their inner Volcker. You better be careful you get what you wish for in a levered system.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
TK takes Halloween really seriously.
Yes, he does.
Which is why he took the day off. It's not the first time, you know.
Yeah,
he spends the morning dressing up. It's TK's thing. Live from New York City this morning. Good morning to you. This is Bloomberg Surveillance on TV and radio alongside Lisa Abramowicz. I'm Jonathan Ferro. CPI in Europe out just seconds ago, coming in really, really hot. We'll talk about the next central bank decisions a little bit later this week. But Bramo, 10.7% on CPI in a Eurozone this morning.
And this really highlights the tension because the third quarter GDP grew more than estimated, right? More than expected at 0.2% versus the estimate of 0.1%. So how much are we looking at this idea of consumer prices rising faster than expected, but the economy is still hanging in, basically prodding the central banks to keep raising rates?
The economy hanging in for now. The PMIs in Europe last week in the 40s. Brutal. 75 basis point interest rate hike. It's not looking great for some of these central banks really struggling at the moment to maintain financial stability, to try and get inflation down and support growth simultaneously.
So Mike Wilson actually has talked about peak inflation, that perhaps people are getting it wrong this time, as wrong as they did in 2021. But on the other side, that actually inflation is going to drop much more quickly because of all the tightening that hasn't worked its way into the system. I wonder how much we start to hear that. I wonder how much the Fed starts to confirm that belief. And then what does the market do, right? They take that and run with it, and then they have to backtrack. Or do they understand? Do market participants understand this means a slower growth, slower bleed, slower margins in some of the companies that we see reporting?
The biggest challenge for the Fed this Wednesday is how do you communicate some form of step down that you're open to dropping, say, from 75 to 50 to 25 without triggering a premature easing of financial conditions, which is arguably what we've seen take place over the last week.
Well, and this is the real key here. How do they communicate? There is a lot of pain, and how does it get confirmed by earnings that have yet not capitulated, right? People don't think that they've really expressed the full pain that will be coming next year in the first quarter. So if you haven't seen the full pain yet, it's going to be hard for the Fed to really sell that without causing some sort of rally in the markets.
Can I just say that last week was truly impressive to see Alphabet, Amazon, Microsoft, Meta absolutely hammered and the equal weight rally every single day last week on the S&P. And the S&P 500, the market cap weighted index, up by, 4% on the week?
So bear with me. This is somewhat complicated, but this is what I was trying to think about over the weekend. When does it not become good news for the Fed to pause or do a step down? When does it become bad news for rates to not go higher because the economy is not doing well? Right now, the rest of the market treated that softer earnings were a good thing for this Federal Reserve looking for more weakness, for more pain. At what point will it just be a bad thing? And at that point, is that when we see the real capitulation?
Futures right now negative about 0.5% on the S&P. Let's whip through the price action for you. Starting with equities, then moving to bonds. In the bond market, 12 consecutive weeks of yields climbing on a 10-year until last week. Last week, yields lower, much, much lower. On a 10-year right now, higher by 5 basis points. Just north of 4%, 4.06% on a 10-year. Euro dollar down by 1/3 off the back of some pretty hot CPI. Got a decent steer that we'd get this off the back of the German inflation numbers, the French, the Italian at the end of last week. But still to see it there, very close to an 11 handle on a Eurozone figure for the month of October year over year. Euro dollar right now, Bramo, 99.37.
10.7%. It's a pretty shocking number considering the no-inflation regime that we had for so long. This week ahead is going to be massive for a whole host of reasons. We get a number of Fed decisions, or I should say central bank decisions, the Fed decision being front end of them all. But also the Reserve Bank of Australia tomorrow gives out their policy decision. The FOMC rate decision will be the key one on Wednesday. What do they signal beyond the step down, the threshold that it takes? Where is their optimism about the economy? And then the Bank of England decision on Thursday will be interesting as well. And this comes as two-year yields around the world continue to climb and hover near the highest levels since the financial crisis. We also get a slew of economic data. The U.S. employment report on Friday for the month of October is the key one. But before that, we also get the JOLTS data, and that comes tomorrow. I'm very interested in job openings. How much do they continue to plummet because companies are sort of soft not hiring, right? They're sort of trying to look, John, for some kind of way to pare back without cutting jobs because they don't know how hard it's going to be to hire people.
Well, freezing is the new firing, right?
Yeah.
You can't fire what you couldn't hire. And that's been a story of the last 12 months. Job openings is going to be fascinating just to see how much that comes in and to see whether we do any damage to the labour market on Friday in the unemployment report. Ultimately, the Fed's goal, what is it? To soften demand in the labour market. Have we seen any sign of that whatsoever in the official data?
Not in the official data, right? Not in the unemployment rate, not when it comes to initial jobless claims, but in the JOLTS data, yes. And in the earnings reports, yes. And that brings me to the third thing that I'm really watching this week, which is almost a third of the S&P 500. About 160 companies are going to be reporting earnings this week, including Pfizer, Uber, Starbucks, Airbnb, Marriott, Kellogg, Hershey, a whole host of them, at a time where the consumer really is the question. How long can they hang in there given the savings that they have, but also the inflation that they're feeling really reduce their buying power?
And let's kick off the programme of the Trading Week with Brian Weinstein, the head of global fixed income at Morgan Stanley Investment Management. Brian, fantastic to catch up with you, sir. Walk us through Wednesday and what you and the team are looking for at this Fed meeting.
Yeah, you guys did a great job setting it up for me. It's going to be a very interesting day. The Fed has a good old-fashioned friend to lean back on called math, right? The Fed has raised rates 75 basis points now at so many meetings, getting up to this 4% level so quickly, and they have to slow down, and the markets want to like it. But then they have to use, I think, some other mathematical tools at their disposal to remind people that the slowdown hasn't started yet, right? Mortgage rates at 6 or 7% is a big deal. Cash and fixed income as a draw of capital, right? As an asset class you can invest in should slow down the economy. And so I think the Fed is going to have to step down to a lower pace, but at the same time remind people that they've done a lot of work and that they still have more to do.
Step down to a lower pace, Brian. Does that mean that the end point will be lower, or does it mean that potentially it could be even higher because it isn't going to cause the market to break in short order?
Yeah, I think it means it could be higher. I think what they're trying to avoid is going 75 at the next three meetings and then easing again starting in, say, March or so of next year. They don't want to do that. They don't want to break anything. What the Fed always wants is to see what have their actions done, what impact will it have. And it happens at such a lag, and CPI being the worst of them all, right, and how slowly it moves. They want to see if end user demand is slowing, and we're starting to see it in earnings. We're starting to see it in anecdotes. So I think all they're doing is buying time so that they can raise more, but do it more slowly.
Goldman Sachs just upped their expectations for the end of the Fed funds rates to 5%. How much have you increased your expectation for the end point over the past few months, and where do you see it potentially going if perhaps they do this step down and it does allow the economy to keep going without some sort of sudden stop?
Yeah, listen, it is scary to look at the inflation numbers, right? They do continue to surprise to the upside, despite the idea that on the other side of this, as Mike Wilson has told us, is a quick slowdown. So we've been steadfast in that kind of 4.5% to 5% range. That's what the Fed told us. We have no reason to believe that that's wrong, and we do believe that inflation will start to slow down, that it is lagging, and it will take longer than we want. So again, I've been a big believer that anytime you get twos near 5% and tens above 4.25%. They're good buys, because I do think the flat curve is telling you that they don't have to go that much higher than here.
So if that's the case, Brian, is one of your biggest conviction calls at this point to just go into 10-year treasuries, go into the longer dated curve, whether it's IG, whether it's treasuries, and just hang on?
I like it. I mean, I don't think you're going to wake up one day and have 10 years back at 2%. I don't think that's the game here. I do think earning that income in high quality assets, by the way, you can do it in agency mortgages, might be the cheapest one, investment grade credit, high grade municipals, treasuries are okay too. Earning that income is, I think, a very powerful ally in a world of high volatility and uncertainty if inflation is falling, because you'll wake up one day wanting to own that stuff. And again, it won't be 2%, but it might be back to 3.25%, 3.5%. And so those are great cash flows to own. We do like them, and we continue to add as rates go higher.
We're less than 2 weeks to the U.S. election, and this is something that people are watching, not only with respect to the economic policy of Washington, D.C., but also the political pressure on the Federal Reserve. How does that factor into your bullish call on 10-year treasuries? What would you think, or how much would you move away from that call if, say, there was political pressure put on Fed Chair Jay Powell to stop hiking rates and to be a lot less aggressive?
we've been debating this, I think, since their actions in 08, maybe even before, about central banks and their autonomy and whether or not that's under pressure. And it has been, right? It continues to be. And yes, if you do see a government that wants to go after the Fed and stop them from doing what they need to do, that does change things, right? It could risk much higher inflation rates. It could risk losing control of the dollar as reserve currency. But those are not things that we're investing on right here. It's easy to talk about going after the Fed. It's much more difficult to actually do it. They've done a pretty solid job. They've made their mistakes. They're not perfect, but I think they've corrected by raising rates a lot, and we're watching it, but not terribly concerned at the moment.
Brian, awesome to catch up, buddy, as always. Brian Weinstein there of Morgan Stanley Investment Management. What I've seen a lot of over the last couple of days is not just the talk of a step down, but maybe of a stretch. Saw that from Evercore a little bit earlier this morning. You add in an extra 25 basis point hike. We've seen that from Evercore, seen that also from Goldman Sachs. So what you're communicating is, sure, we'll basically step down in the pace of rate hikes, but we'll throw another one in there anyway because we're going to stay tighter for longer.
Well, and that's really the key issue, right? Could they potentially talk about a step down and still communicate a hawkish message to the U.S. markets, right? How do they say, basically, look, you're going to like the step down, you're not going to like what comes after because we're going to keep going, perhaps at a slower pace?
Can this not be the step down show for the rest of this week? Isn't
it driving
you nuts? It's been driving me nuts for the last couple of weeks already. Let's get to a serious story. Russia suspended the Ukraine grain deal. We understand that vessels are still leaving, loaded up with crops, but this is something to watch for the next couple of days for sure.
This is actually really painful, and I was watching some of the footage, and I was reading some of the stories. But this is grain that supplies significant portions of East Africa, right? So there are entire nations that could go hungry if the grain doesn't get there, and you're seeing wheat prices surge. How much does this really signal a breakdown with respect to Russia from the rest of the world, and how much they're willing to comply with trying to ameliorate world hunger on the basis of getting more leverage?
On that story, we'll catch up with AMH down in Washington, D.C. in just a moment. Looking forward to doing so in the next hour. James Athey, Investment Director over at Aberdeen, is going to join us on the Federal Reserve step down and the Bank of England and all that good stuff later this week. Live from New York City with equity futures down about 0.5% on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Brazil, it's a dramatic comeback for former President Luiz Inácio Lula da Silva. The left-wing politician has won the presidential election, narrowly defeating incumbent Jair Bolsonaro. 3 years ago, Lula was in a jail cell on corruption charges. Bolsonaro has neither conceded the race nor commented on the results. His reaction will be closely watched by investors. In Ukraine, the government says Russia launched a massive wave of missile strikes across the country. Part of the capital, Kyiv, was left without power and electricity after the missile strike. The attacks came after Russia pulled out of a deal that allowed millions of tons of Ukrainian grain to be exported. Russia withdrew after accusing Ukraine of attacking its warships. In South Korea, the government has opened an investigation into one of the country's deadliest incidents in years. At least 154 people were killed when a crowd squeezed into a narrow alley during Halloween festivities. Reports are that some people began to fall, causing others to tumble and pile upon one another. In Western India, at least 130 people were killed when a suspension bridge collapsed. The disaster happened in Prime Minister Narendra Modi's home estate, Gujarat. Now, the colonial-era bridge had been reopened last week after renovations. Economists at Goldman Sachs now see the Federal Reserve raising interest rates to 5% in March. That's higher than their previous estimate. Goldman's new forecast includes another 75 basis point hike when Fed policymakers meet this week. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
I think the Democrats are going to get a rude awakening on November 8th that, high inflation, high crime, open borders, not what the American public wants.
Don't punish the people who are fixing your problems, and don't reward the people who are trying to exploit the problems for their own political power. That's really the difference right now. We're engaged in the hard work of bringing our country forward, The other side's working on their own power.
1 week to go. Senator Rick Scott of Florida on ABC and Congressman Sean Maloney of New York on CBS. From New York City this morning. Good morning. Here's the state of the market for you. Equity futures look a little something like this on the S&P. Futures negative 0.5%. Call it down 6. Yields higher by about 4 or 5 basis points, just north of 4%. Whole host of banks, Evercore, the likes of Goldman, talking up maybe an extra 25 basis point somewhere in our future in 2023. Euro dollar negative 1/3%, 99.34. I can tell you a little bit earlier this morning. CPI out of the Eurozone, upside surprise, 10.7%. The previous number, 10%. The survey, the median estimate 10.3, and the ECB last week, let me tell you, setting up a flip-flopping President Lagarde maybe. She was in the news, in the media over the weekend, over the last week, Lisa, talking about inflation coming out of nowhere. Out of nowhere.
That doesn't really help her credibility. I mean, it's not like it's boom,
It just came out of nowhere.
It's Halloween.
Sure.
It's like come around the corner and say this boo. There is this question about how much they actually have their hands around inflation. And that's something that's not just for the ECB, but also for the Federal Reserve. How much credibility do they have to really say it's starting to roll over if you're not seeing that in the labor market?
Close to 11% on inflation in the Eurozone. Joining us now is AMH down in DC, Anne-Marie Hordern, our Bloomberg Washington correspondent. AMH, actually wanted to start with the weekend's events in Ukraine and what's been happening with Russia. Russia suspending its involvement in that grain deal. Can you walk us through the importance of that and whether that deal is ultimately still operational?
Well, it's incredibly important and critical, as you heard from the UN, Turkey, the United States over the weekend, in terms of quelling that inflation you're talking about, especially when it comes to global food prices. And the President of the United States saying this is just going to create more starvation and hungry in the most vulnerable communities around the world. So over the weekend, Russia says they are coming out of this deal. What you saw immediately overnight is that wheat prices, soybean oil prices, all of this jumped on the news. You do see some shipments going, but the fact of the matter is, because a lot of this process takes a while to unwind, Russia says they are going to pull back on it. But we should note there was already a lot of concern in this marketplace because that deal was scheduled to end already November 19th. Now what you have is the UN and Turkey really running this offensive, this charm offensive with Moscow to say, please stay in this deal. Russia is saying that there was a strike from one of these Black Sea grain shipments. They also said the UK was involved without offering any evidence, and that is why they are pulling back on this deal. But there's a number of countries that are really trying to put pressure on Russia to stay in this deal because of the harm that it can do, especially going into these winter months.
And Maria, at a time when inflation is one of the top voting criteria that people are using as they head to the polls next week, how much is there starting to be a lot of pushback in terms of holding the line, remaining pretty much hard with Russia, and keeping some of the tension ratcheting up at a time when it is causing prices to go up and potentially really threatening the food supply of many nations?
Well, I think that debate and that tension, Lisa, was on display just last week when these progressive Democrats released this letter that they worked up over the summer, and they had to take it back and retract that letter that said that if we're going to continue sending billions of dollars, whether it's military aid, financial aid, to Ukraine, that alongside that there should be some sort of diplomatic outcome, or at least a path or a goal to have diplomacy. And that was quickly absolutely teared down about their own party, and they had a ton of backlash on it. So I think there is that question floating around whether or not it's the progressives on the left, or you had potentially going to be the next speaker, Kevin McCarthy, talking about the fact that when the House is taken over, in his prediction and most of the other polls' predictions, by the Republicans next week, that they say that there will not be a blank check for Ukraine. And a lot of that has to come down with the fact, as you're saying, there is a lot of pressure on lawmakers to quell rising inflation, whether or not it's grocery bills, whether or not it's rent. These are concerns of the voters. And you see that in poll after poll. This is what is going to get a lot of people out and wanting to vote in this election.
There's a larger issue here, which is basically how much economic pain are you willing to tolerate for national and international security? And it's not just with respect to oil and grain deals with Russia. It's also with respect to Germany and China. It's what's going on where they're setting a coalition over to China on Thursday from Germany to possibly shore up some of the ties there. How much is there unity among some of the Western allies, especially heading into some really contentious midterm elections, to really push that through, even though it does cause economic hardship?
Well, when you're talking about China specifically, there's bipartisan support, and China is always an easy scapegoat and punching bag to get voters rallied up, and what is used by many lawmakers. When it comes to Germany and their ties with China, I think Jonathan one day put it very well. Germany, outsourced their energy to Russia, their economy to China. And at this moment, what you see from the Biden administration, they have these export controls on China. There was just a call overnight, Monday morning, Beijing time, about this. China pushing back on these export controls. China saying that the United States is trying to suppress their economic growth and future. And what you've seen from the Biden administration is that they want this multilateral approach, meaning the United States, Western Europe, and other allies on board with making sure they are competitive and tough on China. But at the same time, you see cracks when you see the likes of Germany maybe sending over a delegation. But we'll see where this comes, because also, of course, we have the G20 coming up right after the midterm elections, and we're going to see President Biden potentially sitting down with Xi Jinping.
AMH, wonderful to hear from you. We'll touch base with you in the next hour. Anne-Marie, down in D.C., did you see the president's comments before the weekend on the oil companies? Check this out for a quote. Granted, it was done at a fundraiser. She'd expect this kind of rhetoric, I'm sure. They talk about me picking on them. They ain't seen nothing yet. That's the rhetoric coming from the White House towards the energy majors over the weekend, Lisa.
Yeah, taking a hard tone. Perhaps it's just that, taking a hard tone. I don't know what else he's going to do. Is it windfall taxes? What can they actually push through before the midterm elections?
No idea.
And, at this point, how much does this really hold any sway versus just campaign rhetoric?
Well, it's campaign versus policy. Those excess profits are going back to their shareholders, their executives, instead of going to lower prices. How much of those profits would they like to go to shareholders, and how much would they like to go to lowering prices? Do they have a number in mind? Is there a percentage that is fair, that is unfair?
Part of me just ignores it because I'm just thinking campaign rhetoric. And then they came out with a very specific number in terms of the downside risk for crude at which they'd start buying. So maybe there is. Maybe you're onto something. Maybe there are some very specific numbers that they are going to unveil.
When Tom and I went down to DC a number of months ago and we talked about central planning, tell us your number.
Yeah.
What's your number if you've got one? What's fair? Futures right now down 0.5% on the S&P. From New York, this is Bloomberg. Live from New York City this Monday morning, here's the price action on the S&P 500. Big week of gains last week on the S&P, a week of gains of about 4%. Futures this morning negative 0.5%. On the Nasdaq, down about 6 or 0.7%. Last week, yields lower as well. Real yields much lower. Nominal yields too, down 20 basis points on a 10-year. Just north of 4% on a 10-year yield right now, up to 4.06%. Yields higher by around about 4 or 5 basis points. More data still to come this week, including the ISM. Fed decision on Wednesday. We've got to talk about Eurozone CPI. Check out the euro. Eurozone CPI earlier this morning came in very close to an 11 handle after breaking through double digits in the last month or so. We were looking for something close to 10%. In the survey, 10.3. The actual number, Bramo, 10.7 on euro dollar. 10.7 was CPI, and euro dollar right now is 99.36.
It came out of nowhere. Where did it come from? It's just a mystery.
Just miraculous, the inflation story for President Lagarde and this ECB.
Yeah. Well, how much is this also because of the weaker euro? I mean, how much are they basically importing inflation because of the strong dollar with relation to their currency? And how much do they address that with policy? How much can they? Do we hear about that in some of their rhetoric? We didn't really hear that last week, but they kind of have to address that.
How can we talk about a downshift in policy with numbers like that in inflation still coming out of Europe, still coming out of the United States?
Unless you start to adjust your target for where inflation ends up. And if that's the case, that would be a rethink. You're laughing, but this is what people are thinking may happen tacitly, even though Fed officials say if we do that, it would be a disaster. That would end up eroding a lot of our credibility, and it would get carried away because people would then put the peg that much higher above what we're saying the new target is.
I think it would make it tremendously difficult to achieve even that target.
Right, but
if they went from 2 to 3.
Correct.
Just because I wouldn't believe them. Then they'd be talking about 4. when 5. They're happy with 6.
This is the reason why people are saying there's going to be a pretty steep downturn in Europe and beyond, because there is no other option. If things are still climbing in terms of inflationary reads and the economy is still chugging along, well, then how much do they have to do in order to really stop that?
Futures right now down 22 on the S&P. We're down about 5 or 0.6%. Andrew Hollenhorst, the Citi, joins us now, the chief US economist. And Andrew's just been fantastic through the whole of this year. I have to say, Andrew, congrats to you and the whole of the team, because I remember when you first came out with those calls for 50 basis point at every meeting, then 75, and everyone started to laugh, Andrew, and it quickly became consensus. Where are you now going into year end as the rest of the pack on Wall Street talks about a step down and financial conditions start to ease?
Yeah, thanks so much, Jonathan, and thanks for having me on. For our base case, we still think that the Fed might end somewhat below 5% policy rates, but we would not be surprised by levels above 5%. I think anything up to 5.5% would not be too surprising at this point. And, it really goes back and kind of thinking all the way back in terms of why this Fed has been more hawkish and why we're getting higher policy rates. It's what you were just talking about it in the European context. We just have inflation data that continues to surprise to the upside, that continues to push policy rates higher.
How do you think the chairman navigates this conversation in the news conference, Andrew, this week, given that they don't have the forecast? There's no fresh SEP until December.
It's really difficult. In December, you do have a lot more variables that you can use to try to guide towards a step down in the pace of policy rate increase, but at the same time not trigger a loosening of financial conditions. And I think we saw a little of that last week as the market got excited about the fact that the Fed might be slowing the pace from a 75 basis point hike at this week's meeting to a 50 basis point hike in December. And we think that is what's going to happen. And that's not necessarily a dovish outcome. The hiking 50 basis points is still a larger than usual sized hike. The Fed could continue to hike at those larger sized hike sizes for an extended period of time, get to higher policy rates. So there's nothing inherently dovish about hiking at a slower pace. What the Fed needs to do is communicate that. And you're right, at the December meeting, there's a summary of economic projections that can show higher dots, suggesting that policy rates will move higher. It's really just going to come down to communication in the press conference at Wednesday's meeting. Can Powell talk about slowing down the pace, but still indicate resolve on fighting inflation?
What's more damaging for the economy, getting to 5% or 5.5% and then cutting perhaps 6 months later, or getting to 4.75% and holding it for 2 years straight?
I think what would be damaging for the economy, and I think to their credit, Fed officials have recognized this, is to allow inflation to persist at levels that are well above target. I mean, you were just talking and, we're kind of joking about the idea, could we get a 3%, 4%, 5% inflation target? But implicitly, that's what happens if the Fed continues to miss on their inflation mandate. If you continue to miss to the upside on inflation, then you embed in the economy a higher rate of inflation. And I think we're already seeing some of the costs, some of the uncertainty associated with not knowing how much wages, how much prices will be going up. That's the real risk for Fed officials. And that's why stopping too early is a risk and could imply actually hiking further at a later date. So you do have upside risk, you have downside risk. It's a complicated scenario. I think the primary risk right now is still the risk that inflation remains too high.
Andrew, you said something really important there, that by basically undershooting inflation again and again, they're basically communicating that inflation is going to remain higher than their target. This sort of speaks to what Diane Swank was talking about, their projections being fantasy land. How much do you think they've already done that by not really communicating some sort of downturn or something that is more realistic according to the economists' projections in terms of what kind of pain needs to happen in this economy to get inflation under control?
Yeah, I think it would be helpful if Fed officials concentrated a little bit more on the fact that labor markets likely need to loosen significantly to bring down inflation. It's a very unfortunate reality. It's a reality that nobody wants to be dealing with. But the empirical fact is that to bring inflation down from levels like the levels that we're seeing in the US and Europe, elsewhere, involves a significant loosening of the labor market. And that's almost a euphemism for saying the unemployment rate rises. Millions of people who currently have jobs no longer have jobs. That's a horrible outcome for the economy. That is the cost of inflation that's too high. And the issue now is minimizing the further cost of that. So I think that's right, Lisa. I think there should be more direct communication about the pain that's associated with bringing down inflation.
Andrew, I can sense even you're hesitating to say it out loud. And we do too around the programme, around the table on surveillance every single morning. And Andrew, I think they've still got to do a better job of communicating this. And it's not for me to do it for them. Andrew, how do they tell us that higher unemployment is a price worth paying to get inflation down? What's the answer to that?
Yeah, it's a very hard message to deliver, frankly. And I think that the answer is to be clear, be forthright, to talk about the historical evidence, talk about the theory. The theory that we have, when you look at the employment cost index last week, up 1.2% quarter on quarter. This is well above a pace of wage increase that would be consistent with 2% inflation. And so I think that's just one indication, a very tight labor market that's going to drive inflationary pressure. There's strong theoretical reasons, there's strong empirical reasons to think that that doesn't change without a loosening of the labor market. So I just think that we need to be clear and forthright about that. And to your point, Jonathan, it is an unfortunate reality. And I think that means that Fed officials and others have been reluctant to comment on it openly.
Andrew, we get unemployment data on Friday. We get the jobs report in America. Right now, I'm looking at payrolls. The survey, the median estimate about 190 from a previous 263. Andrew, can you tell me, as the year has progressed, have you sensed that perhaps this unemployment rate needs to go higher than you thought it did at the start of the year?
So I think there is a sense that maybe the unemployment rate doesn't need to go higher, but that the amount of restriction needed in the economy may need to be more to get to a higher unemployment rate. So we think that the unemployment rate may need to get to something around 5.5% to bring down inflation. That would be a lot higher than 3.5% where we are now. Historically, it wouldn't be as high as what we've seen in other recessions. So there is some good news there if you want to see it that way. I think that the issue is the labor market data continues to be very resilient. 190,000 new jobs in a month is going to be strong enough to continue to put downward pressure on the unemployment rate. So we have a tight labor market generating wage pressure that's too high, and that labor market looks like it may be tightening further. The only evidence to the contrary, job openings, the JOLTS job openings numbers, those have started to come down. We get a new reading on that this week, so I think that's going to be important. But overall, low initial jobless claims, there's just a lot of evidence that this is a labor market that has not slowed sufficiently to bring down that wage pressure.
JOLTS data coming up tomorrow with the ISM as well, and then onto the Federal Reserve on Wednesday, and onto the payrolls report on Friday. What a week. Andrew, thank you, sir. As always, Andrew Hollenhorst there of Citi on the latest and what they're looking for from this Fed this week and perhaps beyond as well. As we were speaking, I got this message from Bank of America. Matt Dezok is going to join me a little bit later, and here's the line. I think the line captures this conversation almost perfectly. The Fed signaling the pause actually makes the pause less likely. That's the dilemma, Lisa, that this Fed faces later this week.
Which is the reason why people are talking about how could they signal some sort of pause and make it hawkish, right? How could they signal a pause, but then also say, oh, but by the way, we're also going to hit a 5.25% Fed funds rate, or we're going to keep raising for longer, or something to offset the potential rally that you get, the easing in financial conditions on the heels of that.
I keep going back to the communication, though. You get the sense it's shaped by the politics of the moment. How did they say exactly what Andrew was talking about? And even on Wall Street, you get the economists talking about what the Fed is trying to achieve, and they're dancing around it too, because it's just something you don't want to say out loud. This Fed is doing exactly what Senator Warren and Senator Sanders are worried about, trying to get unemployment up to get inflation down. That's the pain that Chairman Powell talked about at the back end of August in Jackson Hole, and it's still something I think is very difficult to communicate.
Well, perhaps there is a bigger question around all of this. Has the possibility of a soft landing gone off the table, right? And Mohamed El-Erian said there's still a small chance that possibly you could avoid a recession. Can we get a situation where participation rate starts to pick up, and productivity starts to pick up, and suddenly you compensate for the gap and you get some sort of natural easing out of some of the pressures in the labor market? It seems like maybe that ship has sailed, and that's what people are, I think, are not willing to say right now.
Do you remember the positive supply side surprise we were all hoping for 12 months ago? Remember September 2021? We all thought perhaps it would kick back in, and it never did. On the commodity market, I'm Rita Sen, Director of Research at Energy Aspects. We'll catch up with her shortly. Right now, futures down about 0.5% on the S&P. We're down 21. Live from New York, this is Bloomberg.
Keep Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Brazil, the results of the presidential election signal a change in direction for Latin America's largest economy. Luiz Inácio Lula da Silva was elected in a dramatic comeback for the left-wing politician. 3 years ago, he was in a jail cell on corruption charges. Lula narrowly defeated incumbent Jair Bolsonaro, who has neither conceded nor commented on the results. His reaction will be closely watched by investors. Today, there's a showdown at the U.S. Supreme Court over affirmative action. Justices will hear arguments on admission policies at Harvard and the University of North Carolina. The schools are battling an interest group that wants to overturn precedents that let colleges consider race when they choose students. The CEO of Barclays says the lender's investment banking operation is critical to its success. CS Venkatakrishnan spoke to Bloomberg in his first television interview since taking the job a year ago.
The investment bank has been what has kept Barclays flourishing and quite apart from many of our competitors in the fact that, we performed extremely well during COVID. We are able to have a more diversified business model.
Last week, Credit Suisse confirmed it is looking to downsize its own troubled investment bank after multiple losses. And in the UK, the economy is shuddering to a halt under the weight of the biggest increases in borrowing costs in more than 3 decades. And there's concern that rates will go even higher. Economists and investors expect that on Thursday, the Bank of England will raise its benchmark lending rate by 0.75 of a percentage point to 3%. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The extraordinary investment by the United States and the extraordinary investments we've just heard from the United Arab Emirates and others is just not enough. This is a global crisis, and therefore requires global solutions. So regardless of where you are on the energy spectrum, we must all invest and innovate towards achieving a more decarbonized net zero world.
Amos Hochstein there, the US Special Envoy for Energy. Live from New York, here's the price action for you. Going into a massive week stateside once again. I say that every single Monday. But it is Federal Reserve week, so give me a break. Futures are down 0.5%.
I wasn't going to give you a hard time. I'm
giving myself a break.
Okay, good. Please carry on with that.
Yields up 4 or 5 basis points on a 10-year, 4.0582%. Euro dollar down about 0.4%. If you're just waking up, tuning in, CPI out of the Eurozone. Eurozone CPI close to 11% at 10.7. The survey was 10.3. The previous number was 10. The ECB has a problem, 99.29 on euro dollar, down by about 1/3 of 1%. I want to finish on crude. WTI 86.41, down 1.7%. Prince Abdulaziz bin Salman was speaking at an investor conference in the Saudi capital, Riyadh, last week. And this quote, I saw this quote all over Twitter, all through last week. And lots of people messaged me and said, please talk about this. And I've waited, and here we go. People are depleting their energy stocks, their emergency stocks. They've depleted it. They've used it as a mechanism to manipulate markets, while its profound purpose was to mitigate shortage of supply. Now, if the messenger wasn't Prince Abdulaziz bin Salman, then maybe we take the latter part of that quote a little bit more seriously. But when OPEC starts talking about manipulating markets, maybe people stop listening. But the final line, I think the final line is worth our time. The profound purpose of some of these stockpiles, and we're talking about the SPR here, is to mitigate a shortage of supply. Now, do we have a supply emergency in the energy market that has required the kind of SPR release that we've seen from this administration over the last 9 months?
Well, Republicans are investigating this. This is something that a lot of people would debate, especially because this administration themselves have come out and said, our objective is to lower prices, right? At what point does this become an economic argument that's feasible? I'm not going to weigh in on that. What is clear is that the politics are clouding the fundamentals at a time when China is actually declining in terms of momentum pretty quickly. And how much is that going to ultimately be the driver one way or another, regardless of the political back and forth?
I just think ultimately we've got to talk about how it sets us up for next year, for the next 12 months in the oil market.
Yeah. Well, in other words, how vulnerable is the United States if there actually is a shock and suddenly there is a shortage of oil production? And that's something that's very relevant.
Amrita Sen joins us right now, the Director of Research at Energy Aspects. Amrita, can we start there? Typically, we talk about the near-term story. Let's get out to next year just briefly. How vulnerable is the United States now with the SPR at a 4-decade low?
I think it's a great question. We've calculated this, and even before Prince Abdulaziz said this last week, we kind of highlighted the fact that right now the SPR is actually being used to pretty much influence prices, whereas its objective was very much for supply mitigation. So remember, the SPR also has legislative releases that was agreed back in 2017. So that's another 100 million barrels that's going to come out. We'll end the year this year at just below 400 million barrels, about 380. Deduct another 100 from the legislative releases over the next 3 years. It doesn't leave the administration with much more than 60 million barrels, we believe, that they could do without running into issues with the IEA's at least requirement to have at least 90 days of net import cover. Now, of course, you can continue to run it down below that number, but I will say this again and again, that this is a time of energy security, and running down SPRs to influence prices is probably not the most prudent strategy.
Do you think it leaves America even more exposed to the whims of OPEC next year?
If you don't have SPR, or rather, let me rephrase, if you were using SPR to offset supply disruptions, that's very different. But if you're using SPR to just keep a cap on prices, then yeah, absolutely. Because we've said this before as well, but if you are going to use the SPR to combat OPEC, that's like turning up to a gunfight with a knife, because OPEC has millions of barrels per day of production that they could cut or raise, where the SPR is ultimately a finite volume, which also will need to be replenished at some stage.
Amrita, given the fact that there isn't this relief valve of the SPR that potentially could be tapped in a major way next year, and given the fact that OPEC Plus has that leverage over the U.S. and other nations, are we ever going to see $72 a barrel kind of price levels where this administration said they would like to refill the SPR?
We don't think so. No, I mean, if anything, 5th of December, when the EU embargo on Russian crude starts, that's when you're going to see the real supply disruptions kick in, because this is about shipping disruptions, right? We're just having to tie up so many ships now to move Russian crude all the way to the east. We will start to see some Russian productions shut in, and that's only going to get worse next year. So we just do not see how we get down to the 70s unless and until the economy really collapses and China doesn't actually start to get better, which we expect should start to happen from April next year.
Amrita, based on some of the supply disruptions that you're expecting heading into the winter, and we are getting signs that, you know, it has been mild so far, but the UK, there are just reports that they could see a colder winter than usual. Where could you see oil prices going, and how does that translate to gasoline prices at this highly political moment?
I mean, look, we are expecting prices to go towards $100 into the year end, and really trade into the 110s and 120s for most of next year. And the biggest upside, like you mentioned, is the winter. Of course, weather is always going to be erratic, and nobody can really predict weather. But even otherwise, stocks are just very, very low. Now, you do ask about gasoline. It's a fair question. Gasoline prices in the U.S. have continued to rise because there's so many refineries that are still down. And let's not forget the French strikes that are still ongoing. We're not producing enough. But I will highlight it's diesel that we need to be really worried about. Diesel stocks are at near record lows. We just haven't built over the summer. And that's what we tend to use in the winter if it does get very, very cold. And I think that's a much bigger concern for the administration right now. So we are expecting potentially some form of intervention by the administration, maybe saying you have to hold X amount of diesel stocks in the New York harbor before you can export from PADD 3.
Amrita, I've got about 40 seconds on the clock. I want to squeeze this in. We've been talking about this now for the best part of, 8 months? Call it 9 months, close to. Amrita, have you seen any effort, either from Europe or the United States, to build out refining capacity in a material way?
No, quite the opposite. And it's a great question because, if anything, Europe is talking about windfall taxes on refining. And this is going to be the biggest bottleneck. Next year, we have a few Middle Eastern refineries starting up. But after that, after 2025, we just don't have enough refining capacity to meet oil demand.
And that right there is the problem. Amrita Sen, thank you, Director of Research at Energy aspects, thank you. We talked a number of weeks ago about having a meteorologist on the show instead of having an FX strategist. Did you ever think you would see the FX market move on a weather report?
I mean, that's basically what we've been saying
Seriously?
for the past couple of months. And that's what happened, because you see them say that perhaps you get a colder winter than usual in the UK. That's a game changer for the pound.
Sterling just off session lows, 115.42. We'll catch up with James Athey on the weather in London, in the UK. I mean, seriously, investment director in Aberdeen is going to join us shortly. Futures on the S&P 500 down about 0.6%, live from New York, on radio, on TV. This is Bloomberg.
Earnings coming in is just another data point that people have to absorb to try and understand this narrative.
The source of the negative surprises this quarter has been, in fact, weaker margins than was anticipated.
The market is consistently underestimating the level of inflation by anywhere from 50 to 150 basis points.
The Fed has been leading the most recent push higher in global rates.
Everybody wants to channel their inner Volcker. You better be careful you get what you wish for in a levered system.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Coming off the back of a truly impressive week of gains on the S&P, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowicz, I'm Jonathan Ferro. TK taking a day off for Halloween. Happy Halloween, TK. Futures, a negative 0.4% on the S&P. I say truly impressive last week, Lisa, because Meta got slammed, Amazon got hammered, Microsoft and Alphabet not a whole lot better.
So basically this idea of possibly the Fed could, I'm not going to say it, but maybe reduce the pace of the increases of their rate hikes. I mean, honestly, I can't. You're going to say, this isn't going to be the step down show. So it's not going to be the step down show. It's going to be reducing the pace of the rate hike show. And how much are they basically going to provide wind to a market with communication of just that fact, even if you do get earnings that come in weaker than expected?
So the big challenge, how do you do that? How do you achieve that without triggering a premature easing of financial conditions? And is that what we saw in the last week?
You know, maybe, kind of, but sort of. I mean, we didn't really see any bold moves. If you look at where yields are, they still are around the same levels, and you're still getting about a 5% Fed funds rate next year. If they communicated that they were going to hold rates, they were going to go slower so they could hold rates higher for longer, given the maturity cycles, given how much people need to whittle down some of the savings that they have, that would cause more weakness in this economy than just getting it up to a higher point sooner. And so at what point do people understand that?
In that opening of this program for this hour, you heard Lindsay Biegsa there of Stifel talking about inflation surprises, not just in America, in Europe too. A little bit earlier this morning, about 60 minutes ago, we had Eurozone CPI at close to 11%, at 10.7. That's up from 10 in the previous read.
How much of this is because of the weaker euro? How much of this is because of some of the disruptions that have been ongoing in China? How much is this because of the $1.7 trillion in savings over what they would otherwise have that U.S. consumers still have stockpiled in their bank as a result of some of the programs during the pandemic? How much is that feeding into this higher than expected inflation that continues around the world?
You mentioned China, the data out of China over the weekend. Not impressive. Downside surprise. We'll pick up on that a little bit later. Futures right now recovering off session lows, down about 1% on the S&P 500. Yield shaping up as follows. Higher by 2 or 3 basis points, backing away from the highs of the session at 4.0374%. In the FX market, euro dollar looks a little something like this, 99.38. We're negative about 1% on euro dollar. A softer euro story. I want to talk about crude briefly, 86.57. WTI Bramo down about 1.5%.
Amrita Sen just saying she sees it going to about 100 by year end due to some of the supply constraints and a winter that could be colder. We'll get the weather report coming up. This week, we are looking at a whole host of rate decisions, starting with the Reserve Bank of Australia. That will be tomorrow. The FOMC rate decision on Wednesday really is the key one. How are they going to communicate that they will eventually, as planned, be reducing the pace of rate hikes? And where is their end point? Do they start to communicate the amount of pain that this economy is going to have to feel? And similarly for the Bank of England, although they've got a very difficult decision on Thursday. This week, we also get a slew of economic data, including the employment report that comes out on Friday for the month of October. But before that, tomorrow, the JOLTS report for the month of September might hold more clues in terms of how much softening you're getting. This is the job openings. Are we seeing that sort of soft not hiring that could indicate perhaps a bit of a loosening in this labor market? And then, The earnings really are important. And this week's earnings may be particularly important because they are focused in retail and they are focused in healthcare, some of the areas that have gotten bid up, not retail as much as healthcare. Almost a third of the S&P 500, 160 companies on deck to report. I'm looking at Uber in particular. How long can we keep ordering $20 salads and getting them delivered? I'm just wondering, John. I mean,
is that what was on your mind over the weekend?
I'm just wondering, how much people are going to start to push back and not necessarily take that,
I think last week we talked about how much investment had gone into food delivery and how insufficient investment had gone into things like taking energy out of the ground and building refining capacity and all of those things. I think I saw a quote in the Wall Street Journal over the weekend. It's about investing in real things again. And I think you've talked about that as well over the last 9 months.
Well, and you're seeing this in the tech earnings, right? Have we witnessed massive tech bubble? And when you start to see the deflation of that and the money come out, what's left? And how much does that really lead to some sort of bigger economic deterioration versus an idiosyncratic pothole that allows everything to keep on climbing?
What we all find frustrating is the politics and the difference between politics and making good policy. You hear all these complaints about getting energy prices down, but to catch up with Amrita Sen of Energy Aspects about 10 minutes ago and ask her, have the Europeans or the Americans spent any material time trying to build out refining capacity this year? And they are multi-year projects, and you haven't seen it in a profound way. That's deeply frustrating. What do you expect to happen if you don't build out refining capacity? Where do you think this is going to end up?
Or is this a communication problem where they could have been saying to their consumers, to their people, hey, listen, oil prices are going to be higher. Gasoline prices are going to be higher because we have to invest in a whole host of other energies in order to get to a new reality. If they can't say that, it's going to become a really tenuous moment where you don't invest in what you need right now.
Well, I think politicians want the bridge to the next election and wanted somehow OPEC to provide that bridge for them, as if that was going to happen.
I feel like you just have this real faith in politics right now, John. I feel like you've had this, just pure sense of lack of cynicism.
Well, I have this deep frustration with politicians.
You think?
Regardless of party.
Yes, I know that.
That has existed for a long, long time. James Athey joins us now in the weather, investment director at Aberdeen. James, serious question. Let's start there. How important is the weather going to be for your calls in this market over the next 3-4 months?
We're Brits. We love to talk about the weather, John. Of course, the weather features heavily in all of our investment debates and discussions. Obviously, putting aside my attempts to be facetious there is a direct linkage between some of these government programs and the weather. The extent to which we need a lot of gas, a bit of gas or not much gas will largely depend on to what extent we can be a bit more frugal about using it, but also obviously how cold it is and how much we need to heat our homes. And if governments are capping prices, that means they're on the hook for all of the wholesale price above which they're capping. So it is important. It's difficult, obviously, to factor that into an investment strategy. So I think it's just a risk that one has to be aware of.
James, how does the Bank of England respond to the weather report?
Well, the Bank of England's response to its core mandate has been near impossible to try and fathom on a month-by-month basis. So I'm not even going to attempt to link Bank of England policy to the weather. I'm sure they will feel better today than they did, 6 weeks ago in terms of the stability of markets, the stability of government policy. But really, the problem facing them hasn't changed much from prior to the mini budget. Inflation is still incredibly high, and their strategy is still to hope that the coming recession clears the decks.
James, you've been pretty bearish over the past year, and you've been cautioning everyone on this higher inflationary regime, tighter Fed policy, tighter global central bank policy, and the potential for pretty severe losses. We've gotten them. Are you starting to get more bullish? Are you starting to see more opportunity in what's been baked in?
I guess yes and no. Obviously, when stuff gets cheaper, it looks more attractive than when it was expensive. But my concern certainly with US equities, my concern today is not valuation as much as it is fundamentals. The earnings expectations that are baked into current stock prices still look way too high to me if we're talking about a recession in 2023, which I think we are. If we're talking about just a US recession, that'd be one thing, but we're probably talking a global recession, and we're certainly not talking about China in the immediate future coming out of zero COVID or looking much more healthy in terms of its growth outlook, or indeed in terms of its political priorities towards growth. So I just see this huge quantity of global headwinds, and the US market is still discounting, 5 to 10% EPS growth for 2023, and that just looks way too high. So I still think the underlying earnings picture needs to come down a heck of a lot, and that would be a double whammy if inflation comes down along with growth.
So James, you're not alone. We hear that a lot. We haven't seen capitulation. What does capitulation look like is something I want to know. What does it look like?
Well, for starters, we have to have nobody talking about tradable bear market rallies. Throughout this bear market, we've had a number of commentators, market participants talking about opportunities to buy this market, because actually underneath everything, fundamentals are still okay. And once the Fed has stopped getting in our way, we can just get back to perennial growth. And I think normally when you see a capitulation, you struggle to find anybody anywhere that thinks it's a market that you want to buy. So psychological capitulation, I think, looks different to the extent that there has already been not necessarily capitulation, but certainly extreme bearishness amongst participants and commentators alike. I don't think it's necessarily played out in positioning. I think people are talking more bearish than they're actually investing. And I think that's something that we need to see shift as well, actually a shift in underlying allocations towards equities, or sort of away from equities towards bonds, because the relative valuation story there is as attractive for bonds as it's been in some time.
James Athey of Aberdeen. James, good fun as always. Good to catch up with you, mate.
Thanks, John.
Thank you, sir. Futures right now down by 0.4%. I want to pick up on something James said. It's been a feature of this conversation on this programme for a number of months, in fact, through much of this year. There is still this belief we go back to what we were doing before, pre-pandemic, back to the old regime in the market, low growth, low inflation, low rates, and get long growth equities. That still exists. I hear that a ton. I hear that a lot.
Yeah, and then you've got people pushing back and saying that you're going to get a lost decade, because that's not the case, and inflation remains high, and people say, okay, the sky is falling for those people always disregard. So at some point, you have to get some sort of understanding of where we are. The Fed could be instrumental in that, in terms of their guidance, because if they actually come out and they say, we still think soft landing is possible, well, does that basically signal the opposite, and that they're going to underplay where inflation is going to be at for longer?
Lost decades aren't unheard of. I don't think it's consequential. I don't think it's controversial to say there might be a lost decade within an asset class. Look at the banks after the financial crisis. You look at tech. Look at Japan several decades ago. I don't think it's controversial to say it.
Have you been speaking with someone called Hugh Henry?
We had a good chat
Henry?
last Friday.
It was a great chat. It was really good, but he has some pretty dire projections.
He's a deep thinker.
He is.
He was dragging me down with him a little bit.
Yeah. I know, I can feel it today.
Somewhat
but it's
philosophical
good.
over the weekend. Thinking Hugh's right. Hugh's right. No, that was just my thoughts and not my conclusion. Futures down by 1/3 on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Brazil, it's a dramatic comeback for former President Luiz Inácio Lula da Silva. The left-wing politician has won the presidential election, narrowly defeating incumbent Jair Bolsonaro. 3 years ago, Lula was in a jail cell on corruption charges. Bolsonaro has neither conceded the race nor commented on the results. His reaction will be closely watched by investors. In Ukraine, the government says Russia launched a massive wave of missile strikes across the country. Part of the capital, Kyiv, was left without water and electricity. Now, the attacks came after Russia pulled out of a deal that allowed millions of tons of Ukrainian grain to be exported. Russia withdrew after accusing Ukraine of attacking its warships. In South Korea, the government has opened an investigation into one of the country's deadliest incidents in years. At least 154 people were killed when a crowd squeezed into a narrow alley during Halloween festivities. Reports are that some people began to fall, causing others to tumble and pile onto one another. In Western India, at least 130 people were killed when a suspension bridge collapsed. The disaster happened in Prime Minister Narendra Modi's home state, Gujarat. The colonial-era bridge had been reopened last week after renovations. And inflation in the Eurozone has surged to an all-time high. Consumer zone jumped by 10.7% from a year ago in October, and that was much higher than the median estimate in a Bloomberg survey. Meanwhile, Eurozone GDP rose 0.2% in the third quarter, and that beat estimates, but was much less than the 0.8% gain in the second quarter. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
The political pressure is a counterproductive strategy from the point of view of those who launch it. Frankly, the Fed doesn't listen, and if anything, feels more pressure to prove its independence, so they don't influence short-term rates and what the Fed actually does.
What a tightening cycle we've seen already from this Federal Reserve, and we're set to get another 75 this Wednesday. That was Larry Summers, the former Treasury Secretary, on Wall Street Week with David Westin over the weekend. Futures look like this on the S&P 500, down 1/3%, just bouncing off the lows. Yields are higher by 2 or 3 basis points on a 10-year, 4.0395%. A little bit earlier this morning, talked about this a few times already. Upside surprise on Eurozone CPI. Inflation in Europe coming in hot, hot, hot. 10.7%. The survey was 10.3. The previous read was 10%. That's a Eurozone inflation story. Let's get to the prospect of more inflation still to come. Over the weekend, Russia exited a grain deal with Ukraine. This is what they've had to say just now, just seconds ago. So let me work through these headlines with you. This from the Kremlin spokesperson, Dmitry Peskov, said the Black Sea grain deal can hardly continue without Russia. Goes on to say, without Russia, the shipping grain under the deal would be, quote, much riskier. They are in talks with Turkey, with the UN over the grain deal. And, of course, Turkey and the UN fundamental in striking this deal earlier this summer, Lisa. But at the moment, Russia suspended their involvement in it. We also know, based on our reporting this morning, that vessels have continued leaving with grain. Whether that continues, though, without Russia's participation remains to be seen.
And let's be clear what this means. That basically, if you're going to be operating a ship, that you don't know whether you're going to get bombed down if they're not part of this perhaps safe agreement, right? And that's sort of the issue here, is that how do you guarantee safe passage of essential food for many places in this world?
Well, at the moment you can't, and that's the problem. And AMH has been all over this story over the weekend, I know. She joined us now from DC. Anne-Marie, go through it piece by piece and tell us what you've heard from the White House and how they've responded to this.
Well, the White House, alongside the United Nations, Turkey, they want to see this deal continue, Jonathan, because of the issues regarding inflation and the fact that really Ukraine has just this outsized proportion in the world when it comes to grains, especially to these communities in Africa and the Middle East. So they want this to continue. Over the weekend, the Russian Defense Ministry, and I read the statement myself alongside their telegram, talked about the fact that they said there was a drone strike, and they think potentially it came from one of these Black Sea grain ships. They also said the UK was involved. They gave no evidence of any of this, but they said because of this, we are pulling it out. Now, many would say this was always going to be a potential because they had that November 19th deadline to renew this agreement. And potentially some people were thinking the way Putin has played politics with natural gas and oil, he may again play politics with grains because he knows how critical this is to the global economy, to the crop market, and to global inflation, which is hurting the West tremendously. But Jonathan, as you mentioned, we do see some of these ships still leaving the port. The issue is, will it continue? And you're going to see a lot of background negotiations between the United Nations and Turkey, which are on the forefront of trying to salvage this deal.
What does this mean in terms of the U.S. exporting additional grain to stave off, to make up the difference for nations that might be running short?
I mean, there's potential of that. There's been around the world from these Western allies the hope to want to step in and help, especially when it comes to things like fertilizer in Latin America that has really pushed up prices. But at the same time, Lisa, back to every other commodity, every country is facing this similar issue. So you also can see potentially others wanting to hoard all of the either grain or fertilizer they get a hand on so they can lower their own country's food inflation numbers.
Why would Russia want to do this? I mean, what is in it for them? Are they actually thinking of terrorizing some of the ships, or is this basically a negotiating tactic to hold some of these grain supplies hostage?
Well, we just don't know. What we do know is that they said because of this strike that they are immediately pulling out of a deal. That could be them just using this as leverage or potentially creating more problems for the West, which have very harsh sanctions on Russia. And some of those sanctions, like export controls, which we saw the United States and their allies put in place in February and March, they're now starting to be seen. When you see airlines in Russia that are flying a tremendous amount of roots domestically, but cannot get the parts they need because of export controls, you're starting to see some of this bite. And we're going into the winter, and Putin knows that what is top of mind for every single Western leader is inflation. Look at the European numbers today, a fresh record, exceeding expectations. Look at what's happening in the United States. The number one issue that you have individuals coming out, the Democrats are likely going to lose the House for, potentially the Senate, is inflation. So he has the world right now exactly where he needs them to put more pressure when it comes to these basic commodities like grain and like commodities like natural gas and oil.
1 week to go, Anne-Marie. 1 week to go for the midterms. How does this all play into it?
Well, this will be part of the inflation story. I also think potentially if you do see numbers start to tick up even more in the United States because of what is going on, you may see more pushback. Like we heard from Kevin McCarthy saying there's not going to be a blank check for Ukraine anymore. And then you heard from progressive Democrats, which then they retracted. But the notion is out there that they said if we're going to spend these tens of billions of dollars to Ukraine, there needs to be a diplomatic pathway. I think, though, Jonathan, what you will for sure see over the next course of a couple of months, maybe some disagreement on the fringes, but the most majority of the United States politicians do want to have a bipartisan front when it comes to making sure they are implementing punishments on Russia, but at the same time securing and helping their friends in Ukraine. But the blowback is going to be difficult if it really starts to hit their constituents.
Anne-Marie, just one final question, if I may, and it's been a lead story quite rightly over the last few days here in America. The health of the Speaker's husband. How is he doing now?
Well, he does seem to be doing better and recovering. Speaker Pelosi put out a Dear Colleagues letter over the weekend, thanking everyone for their support and just talking about the fact that her family, their grandparents are really, this was so traumatic that their pop is what she called him, was attacked in this way. And Jonathan, it took center stage on the Sunday shows yesterday. And really you saw the Republicans come out and really attack what went on, saying that there is no place for this type of violence in politics. At the same time, we also, though, heard from the Republican National Committee chair saying the fact that crime is going up and this criminal could still be back on the street. So that's one way that it's being spun. And then from the Democrats, what you really heard is the fact that they are linking this attack to political rhetoric from the right and from the individuals that are more the extreme part of the right that support the former president, Donald Trump. This will be a key part of the midterms next week.
MH, looking forward to your coverage of it. Anne-Marie down in Washington. Anne-Marie Hordern, our Washington correspondent. Futures right now down a third of 1% on the S&P. We're going to catch up with Michael O'Rourke in just a moment, the chief market strategist at Jones Trading. Push forward to a Federal Reserve decision later this week and tons of economic data as well. Futures down, yields higher from New York. This is Bloomberg. Operation Step Down. Going to talk about it all week over at the Federal Reserve.
Self-inflicted.
It's all everyone's talking about.
I know,
Futures
but
down,
you're going to complain about it.
0.2 on the S&P. I'd complain about it anyway, let's face it. We're down 0.4 on the Nasdaq 100. Equities a little bit softer, lighter, lower, negative after a really tremendous, truly impressive week of gains on the S&P. To see big tech disappointing the way it did, ex-Apple, Alphabet, Microsoft, Amazon, Meta, just hammered after earnings, and your equity market still posted a really decent week of gains on the S&P, on the Nasdaq too. Elsewhere in the bond market, we look a little something like this, 2s, 10s and 30s. Think about where we've been a couple of Fridays ago on a 10-year, 433, very close to 434. On a 2-year, a couple of Fridays ago, we were at 463. Right now, a 2-year, 447. Yields higher by 6 basis points. On a 10-year, just north of 4%, 4.03%, up by a couple of basis points. Got to talk about the euro as well. Opening the door maybe to a step down at the ECB and
just keep going.
Then getting hammered by CPI. Euro dollar, 99.32, down a third of 1%. Inflation early this morning, Bramo, 10.7% in the Eurozone.
Yeah.
Record high CPI.
Versus the 10.3% expected by analysts. At what point is that going to be a problem? The analysts keep getting wrong how quickly inflation keeps accelerating. That is a problem in and of itself.
What I love about the European numbers is the regional breakdown going into the headline print. So we basically knew we'd get an upside surprise once we got the numbers from Italy, from Germany, from France. And your point on that, I think, is tremendously important. To see Germany and the inflation numbers there just run away in the way they did. It's just remarkable at this time of the year still.
It's a game changer, and it raises a question of how much of a handle some of these central bankers have on it, especially when they say, came out of nowhere, like you pointed out.
They got a handle on it.
Yeah.
They sound like politicians, don't they?
How do you feel about that? All right, we'll get to that later.
Inflation came out of nowhere.
Yeah, well, all right.
We could
get there. Yeah, the cynicism, which is warranted, by the way. Let's get some movers that are a little bit safer. Right now, I'm looking at AMD, Advanced Micro Devices. This is one of the chip makers that are falling today as a result of what's going on over in China, and that's why I really paired this with Alibaba and Baidu. All of those shares declining. COVID-related shutdowns just keep happening, and now they're targeting Foxconn Technology Group, which is one of the biggest iPhone producers. And the crackdowns have led to these huge protests with people fleeing the factory. And now you have the possibility of iPhone manufacturing going to other places in China. It just highlights, especially on the heels of that weaker than expected data, John, how much China is still very much in a pandemic that the rest of the world seems to have moved on from.
I was just getting the data out of China on my screen. This came out overnight. 49.2 on manufacturing, 48.7 on non-manufacturing, the two PMIs there. Not just China, but Europe too now in the 40s. So if you think about the three-legged stool that is the global economy, China, the Eurozone, the United States, you've got China in the 40s, you've got the Eurozone in the 40s, and we get the ISM for America tomorrow. Things aren't looking great.
Well, and China cannot be the engine of growth, and it cannot necessarily be the supplier that it once was because of some of these disruptions. And so what does this world look like with a China of a sub 5% growth for a longer period of time? These are some of the things that are kind of factoring in to the longer term view versus the short term view. I'm also looking at some of the commodity space, BP, for example, which is going to be reporting earnings this week. Those shares lower, as are ConocoPhillips, also reporting earnings just directly on the heels of oil prices that are going down. Why? Possibly because of those China numbers, right? I mean, that's a big thing. And I put Barrick Gold in there, down by about 0.25% right now. Do you know that gold is poised for its longest losing streak going back to the 1960s?
Did not know that.
And to me, this is fascinating. We're talking
on
about
a daily
inflation
basis.
on a monthly basis, 7 months
basis.
straight. But to me, it's just striking at a time when you talk about inflation and gold in the past being an inflation hedge, it has not worked, and it highlights how difficult this market's been.
This is Operation Kill Inflation.
Yeah, well, I mean,
now, isn't it?
Well, but why have we not gotten gold rallying if we're still having inflation now?
Behaving in line with break-evens, perhaps as well, in the market, taking down inflation expectations. That's what the market's positioned for, is effectively what I'm saying. It's not my opinion about what I think should happen. It's just what the market's been priced for.
In a previous era, when people were worried about inflation, they went into gold. They didn't say, what's going to happen with break-evens? I need to hedge my gold position with that. So I'm just saying it's notable that there's been such a long losing streak here.
I think it was Hugh Hendry on Friday that said gold didn't perform the way he thought it would in the financial crisis either. That was the point that he made too.
When you financialize a shiny metal, it does weird things.
Yeah.
Just carry on.
Okay, good. Get to Mike Wilson and Morgan Stanley. Lisa mentioned the short-term, long-term divide. This was Mike Wilson on the short-term story. Bear in mind that this is a select quote, and when you read through the rest of the note from Mike, he's not exactly constructive on the future here. He thinks ultimately at the start of 2023, you do get to this situation where the earnings story doesn't look great and the market starts to roll over again. But him and the team are really leaning into this short-term, near-term, optimistic, constructive story. He said the following overnight. Week 3Q earnings hammered some of the biggest tech darlings, yet the S&P 500 and even the Nasdaq 100 ended the week up 4% and 2% respectively. He went on to say, our call is still for the rally to reach 4,000, maybe 4,150. We're leaning towards the upper bound of that. I want to get to Michael O'Rourke on it, Chief Market Strategist at Jones Trading. Mike, what do you make of that? Just the short-term and then the medium-term story, this short-term story that we can squeeze out this bear market rally a little bit further.
I mean, I think there's Mike Wilson has valid points. Obviously, he's been spot on the market and he's had a really great call. But what we're seeing is an environment where, as you noted when you started the segment, the S&P 500 was up 4% last week amidst basically terrible earnings among the key players. And that's on top of almost 5% gain the week before. So you are seeing the short-term trading activity that I think is more technical and it's dynamic. And I think it's become kind of expected. I think throughout the first 3 quarters of the year, everyone knew the outlook was bad. Everyone was very cautious. Everyone was very patient. And I think as Q4 started, people wanted to put money to work. And I think that's what we're seeing here in October.
Is that a wave you want to carry on surfing? Because the S&P equal weight was up 5.5% last week. The Russell of small caps, Michael wrote the small caps were up 6% last week. Do you want to carry on chasing that?
No, I definitely do not. I'm the guy you probably bring on to scare people on Halloween. I think the environment's much different. The outlook going forward is much different than we've had for the past couple of decades, where it's been this benign inflation environment that really allowed central banks to have this easy monetary policy. And not to say we're going to super tight policy, but again, we're going to have the Fed funds rate at its highest level in 14 years this week. And we're looking at a 4% Fed funds rate with more hikes to come. Meanwhile, the average over the past 2 decades, it's averaged 1.28%. So it's an environment investors are not accustomed to. And I just don't think they're looking forward to 2023 and saying that's going to be a little more challenging, which I think what I'm saying kind of aligns, for different reasons, maybe aligns with what Mike Wilson's saying. It's just not going to be as great for earnings and for companies.
So let's talk short term and long term. Short term, in other words, you could see whatever you potentially want to see in terms of a short term bear market rally like Mike Wilson is saying. But Michael O'Rourke, what does this mean over the next 1, 2, 3 years with respect to stock market returns? Where do you differ from some of the others in the market right now that see us going back to a low inflationary, low rate regime?
So ever since the global financial crisis, we've had this negative real Fed funds rate environment. If you use the headline inflation or core inflation, and I think what the Fed is trying to get to is a positive real Fed funds rate using core inflation. So we're about 200 basis points away from there. So we need to do that through a combination of rate hikes and obviously inflation coming down, which is going to happen. So, but it's the type of situation where it's going to take time, and that's why we have this whole higher for longer mantra out there. I think the time horizons between the markets and the Fed, and even the policy adjustments we've hit cross currents where the time horizons are different. Everyone's been negative on the market since the beginning of the year, so it's been 9 months. The Fed only really started tightening 6 months ago. Those tightening measures are only starting to take effect now, as we've noticed in earnings. Earnings last week was the first time it started really hitting home. So we still have this to play out over time. But investors are sitting there saying, we've been disciplined, we've been good all year. Maybe it's a time to buy stocks when, obviously we hit new lows a few weeks ago, and people just decide to buy the dip and are hoping for a rally into year end. And I think what you're going to see happen here is the rally is going to run its course, but then you're still looking at a situation where some very high profile companies had very disappointing earnings, and you're not going to see new money flowing into those names in a meaningful way beyond passive index flows.
Michael, this wasn't that scary. Happy Halloween, sir. Michael O'Rourke, Jones Trading. Michael, thank you. I think we're used to it after about 9 months of it now.
We didn't get into the
performance of this market.
We didn't get into the really scary stuff, though.
What's the really scary stuff?
Really scary stuff is what happens after that. The whole lost decade and stagflation.
Didn't we mention that a little bit earlier? Look, we've talked about pricing the bulk of the tightening cycle. We now need to discuss the consequences of the tightening cycle and just how much we've done in such a short amount of time. I bring up Fed funds on the chart on the Bloomberg sometimes just to go through it again and go through the previous tightening cycle, which was 225 basis points of tightening in 3 years. And we've done 300 basis points in 6 months so far this year.
What's been shocking me is how immunized this market is. I mean, if you take a look, for example, at corporate debt and how far they've pushed out the maturities of some of their debt, how much consumers really haven't taken on as much debt that is floating rate that they're going to have to adjust to. There's so many things that make it an economy that's not going to respond very quickly to Fed funds rates that are higher for a long time, which is why I keep going back to this idea of how long will the Fed hold those rates at that level. And that's where I think it's probably going to bite a bit more.
That's the most important point. And I've caught up with Lotfi Karui at Goldman on this. I've spoken to the team at Morgan Stanley about this. And they're basically suggesting the maturity wall isn't right here, but it is out there in the future. And the longer you keep rates here, the more problematic that starts to become. This year, arguably what you have seen is supply fall off a cliff when it comes to high yield, which has been supportive of what's happened with spreads. We've talked about the quality of the index really improving relative to where it was 5 years ago, which speaks to why spreads aren't wider than maybe people thought they would be. But the further you go with rates and the longer you keep them there, then you do start to have a conversation maybe in 12 months' time about a maturity wall being on the horizon. And that's not the story right now, but but could be a story for 23.
Especially at the same time when that maturity cycle becomes a problem politically as well for the United States.
The sovereign issue.
Yes, exactly.
As well. Futures right now on the S&P down about 1/3 of 1%. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Brazil, the results of the presidential election signal a change in direction for Latin America's largest economy. Luiz Inácio Lula da Silva was elected in a dramatic comeback for the left-wing politician. 3 years ago, he was in a jail cell on corruption charges. Lula narrowly defeated incumbent Jair Bolsonaro, who has neither conceded nor commented on the results. His reaction will be closely watched by investors. Today, there's a showdown at the U.S. Supreme Court over affirmative action. Justices will hear arguments on admissions policies at Harvard and the University of North Carolina. The schools are battling an interest group that wants to overturn precedents that let colleges consider race when they choose students. The CEO of Barclays says the lender's investment banking operation is critical to its success. CS Venkatakrishnan spoke to Bloomberg in his first television interview since taking the job a year ago.
The investment bank has been what has kept Barclays flourishing and quite apart from many of our competitors in the fact that, we performed extremely well during COVID. We are able to have a more diversified business model.
Last week, Credit Suisse confirmed it is looking to downsize its own troubled investment bank after multiple losses. And private equity firm Blackstone has agreed to buy control of Emerson Electric's climate technologies arm. The deal values the business at $14 billion. The business sells products like compressors that are used in heating and cooling equipment for offices and homes. Emerson will keep a minority stake. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
We are expecting prices to go towards $100 into the year end and really trade into the 110s and 120s for most of next year. And the biggest upside, like you mentioned, is the winter. Of course, weather is always going to be erratic, and nobody can really predict weather.
And Rita Sen in the last hour of Energy Aspects on this programme. Brent Crude this morning, good morning to you, down by 1.1%, 94.72 on WTI 86.56. Down by 1.5%. My good friend Manus Cranny standing by in Abu Dhabi now with a tremendous interview. Let's get straight over to him. Morning, Manus.
Jonathan, a very good morning to you. Yeah, that's a punchy old call from Rita Sen at 110, 120 bucks for the winter. Let's see whether Russell Hardy agrees with me. He's the CEO, not with me, but with Amrita, of Vitol. Good to have you with me, Russell. A busy ADIPEC. I'm looking at oil at 94 bucks, up 10% in the month. Talk to me about the real market. Is there a sign of demand destruction at any level here?
Oh, absolutely, absolutely. First, good afternoon, and yeah, it's a bit. There's plenty of people to talk about the oil market here, but I'll give you just a few thoughts. The supply side's obviously been constrained a little bit by OPEC. The supply side may well be a little bit constrained by the Russian sanctions in the future. The supply side is clearly at or close to its max. There's not a huge amount of spare capacity, so that creates a little bit of supply side tension and makes people a little bit worried. But on the flip side, on product demand, if we were doing this interview in January, I would have told you that we expected demand to be 2 million barrels a day higher now than it actually is. And why is that? That's the war, that's inflation, that's the price impact on consumers, and all of those, and of course the Chinese lockdown situation. So on the product side, you do see significantly lower demand, and obviously that's helping keep prices in balance.
Is the bar to demand destruction a lot lower now? We're talking about rates in the States at 5%. We've got jumbo hikes coming from Europe. We've got inflation at 10%. The bar to demand destruction, is it getting incrementally lower?
I think a lot of economies, a lot of emerging market economies, Q2 saw the highest prices. So if anything, certainly across Africa, we've seen a little bit of restocking when markets eased in September. I think it remains painful. It remains difficult for many countries, and so as a result, yeah, we're still going to continue to see that demand destruction, I think, for another few months.
Let me flip it to the other side. There's been just tiny moments of reprieve in the quarantine aspects for China. Tiny, very incremental, not fundamental. If there is a structural shift in China's reopening narrative from zero COVID, what does that do to demand structure and price for oil?
So, of course, I think everybody expects some improvement in mobility and movement in China some point during 2023. It's probably more likely the second half of 23 compared to the first half. But in the meantime, the Chinese economy, in terms of exports to Western markets, is feeling the other side of the coin of the high energy prices, because the consumer spending is reduced. So yes, we'd expect a resurgence in demand from China. Yes, we'd expect a resurgence in aviation demand, for instance, which is still a long way behind where it might otherwise be. But all of that's probably more likely in the second half of 23. And in the short term, we're still dealing with the reduced growth, the damage from inflation and interest rates.
So the other dynamic is December the 5th, we get another set of sanctions. About 2 million barrels a day will flow away from Europe on the oil market. Descalzi, Claudio said to me this morning, that impact of that flow of supply into Europe, does that all just go to India and China?
I think it's difficult to say at this stage exactly where it's going to go, but it's likely to go east rather than west. There are some markets in the west that may be suitable for Russian products, but most of the crude, I would imagine, will follow the path of the existing crude, which is to Asia.
Part of your role at Vitol is to ship that. You're still shipping Russian crude. No. You're not.
No.
My apologies.
We announced in April that, or April or May, that we'd ceased shipping crude oil. We still do a little bit of products business, but it's not a significant volume or a significant contribution.
What shifts the dial in this market? Strong dollar, Fed on the move, China reopening. What is it that shifts the narrative in the oil market? Is it another cut from OPEC? Is that the biggest risk on the desk at the moment between now and Christmas?
I think the biggest risk is the one you just highlighted, which is how much of that Russian oil production makes its way to markets. There is a risk that Russian oil production in some way gets shut in Russia because of logistical constraints or issues around the price cap legislation or issues around the European sanctions. And so I think that's probably the biggest short-term risk. And lots of commentators have got a different view on it, anywhere between 500,000 barrels and 2 million barrels of possible supply loss as a result of just the difficulty in getting the product from A to C instead of B.
Just to close, we've got a lot of speculation about a price cap on gas in Europe. Is the politically poisonous truth that in Europe you need demand destruction and not price caps on gas to settle this market?
Yeah, I don't think the expectation was that the price cap would be at a moderate level. I think it's more about dealing with some of these runaway type of prices that we had in August. So in August, the futures market ran up to 343, totally unaffordable. Industry can't afford it, customers can't afford it, and so I think the EU is thinking about how they can prevent that kind of financial stress and strain occurring in the wholesale market.
I'm going to squeeze you in 15 seconds. Where do you see the price of oil 23?
When in 23, it's going to be volatile.
It's going to be what?
It's going to be volatile. So one would expect. I feel it's a little bit soft at the moment, and a recovery is due next summer.
Okay. Russell, thank you very much for being with me. Those rounds of applause, Jonathan, were for squeezing another CEO to try and give me a price of oil between now and Christmas of next year. From a rowdy corridor, I've got the penthouse corridor suite here at ADIPEC. Everybody's
Lucky
here.
you. Lucky
Jonathan.
you. The applause is always for you, Manus. Thank you, sir. Manus Cranny there with Russell Hardy of Vitol. Vitol, just one of those institutions with a fantastic eye line into what's happening in the oil market. Demand destruction, a theme that came up in that interview, at least for a number of times.
It seems to be the one thing that many places are trying for, right? How do you encourage demand destruction at a time when you've got limited supplies? And how long is that going to be the theme?
Do you think that his view of what's happening in the oil market right now is pretty well aligned with what we heard from OPEC in the last month too?
I would guess so.
Basically.
I would guess that, yeah, they're pretty much in alliance.
Futures right now, down 0.4%. Not sure they'd like that word alliance. Bramo. On the S&P, we're a little bit
It's
softer.
Halloween.
From New York, this is Bloomberg.
Our expectations right now are basically plus 3% earnings growth.
We do expect the Fed to maintain this aggressive pace into the end of the year.
As monetary policy goes deeper into restrictive space, each incremental hike is going to be more difficult to justify.
The one thing the Fed cannot afford to have anyone say is they're not credible.
Frankly, nobody knows what the market is or should do going forward, given the complexity of the new macro environment that we're in.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Actual tweet moments ago. Can Bramo do all her bear market bits today in a spooky voice whilst holding a flashlight under her chin? Surely today is the prime opportunity. Thank you, Jay Hardy, out on Twitter for that one. Can you?
Well,
Let's get the torch and talk about how bad everything is right now.
Have you brought a flashlight or a torch?
I don't have a
as
flashlight.
Well, then I can't do it. I'm sorry. It's not going to work. Maybe later.
Do you not call it a torch? I call it a torch.
We call it a flashlight.
Okay.
A torch is like burning. You throw it in, and it's
No,
like,
no, I
you know,
don't want
Hallows
like
Eve.
No,
you know, that's
don't,
not really
don't go
gonna
that
work. Okay.
far.
Good morning. Good morning.
Do you want to do it? I can do it again if you want.
Okay, go ahead.
Good morning. Good morning. After the tremendous rally we had last week, is there anything bearish to say? I have to say, I come away from last week just thinking how tremendously resilient this equity market was in the face of some terrible earnings we got from 4 major tech players.
I feel like a broken record, and I hate going back to this because it's really kind of not that interesting anymore. But people believe that if the Fed starts to slow the rate of increase of their rate hikes and that we are reaching peak inflation, as Mike Wilson thinks, that's going to give a lift to markets. Will it, right? I mean, this all goes down to some of the earnings that we've seen and whether they continue to deteriorate heading into next year.
And then what the Fed does beyond, say, November. November was always going to be about December. I've had a lot of pushback this morning against this step-down chat because how many times have we gone into a Fed meeting expecting the step-down this year and ended up with 75 and again 75 and again 75. And for whatever happens at this Federal Reserve meeting on Wednesday, in the following week, we'll get CPI in America. And I'd say let's go to the ECB for a playbook. If you want a playbook right now, never mind the RBA and the Bank of Canada, look what the ECB did. Open the door to a step down. 2 days later, got CPI data, Friday out of Germany, France and Italy, Monday for the Eurozone close to 11%.
Which is a reason why I suspect that the likes of Bill Dudley are going to get more voice, even more voice. I mean, he's had a lot of voice, but he's been right. And how much can you start to see those end rates climb even higher? Because we've talked about this, right? The economy is not responding as quickly to these rate hikes, and inflation keeps surprising to the upside. So at what point can you imagine, okay, a slower pace, but get to 5.5% even?
Slow stretch and raise. That's the approach that Evercore's looking for. Slow stretch and raise. Do you think that that's going to be the one that people go with?
No,
on
I don't.
Thursday morning.
Slow stretch and raise. It sounds like what we should do on a Monday morning.
I get it. What they're saying is that basically if you do step down, throw another 25 basis point hike in there for next year, just to communicate that you're not giving up anytime soon. You're going to stick with it for a long time. Does that make sense?
My head is spinning.
Does that work
I
for
mean,
you?
maybe that will give some sort of hawkish feel, but people don't believe that this Fed has conviction. And I go back to this discussion around, are the Fed's projections realistic? Do they have to say, we are going to see unemployment rise, people are going to lose their jobs, we don't like this, but it is a necessary condition in order to let inflation come down a bit more? If they say that, and then they say, okay, and we'll have a slower pace but a higher end point, maybe people will believe that.
Powell told us. Jackson Hole, Wyoming. So did the ECB. Chairman Powell talked about pain repeatedly. I keep going back to that speech just to reflect on it. You had the same thing as well from Isabel Schnabel of the ECB, who talked about a willingness to hike interest rates even into a recession, if that's what materializes. That's the playbook from these guys.
But the projections haven't reflected that.
Sure.
And that's a big deal. And not only that, but we haven't gotten the pain yet for them to respond to. And people say, yeah, right. When we actually start to get the people getting laid off, you start to get the political pressure, you start to get the stories of people who cannot afford the day-to-day costs, it's going to be a different story.
Wasn't that the whole point of the operational independence of central banks? That they weren't meant to be touched by the political cycle? That they were meant to make these hard calls? So why don't they make these forecasts? Why is it just the Bank of England the only one who's basically saying, you know what, I think we're going to have a recession?
Right now, they're damned if they do and damned if they don't. They're going to be political any way they cut it. Either they're going to make it harder for governments to borrow, or they're going to basically succumb to the political pressure of the incumbent party. Either way, they're in a terrible spot, and a lot of this is because the fiscal side has been really derelict with their duty to really invest in the real economy, like you've been saying.
Futures right now down about 0.5%.
Getting off my soapbox
the
now.
S&P. That just needed the torch or the flashlight.
It's spooky voice.
Futures down just a touch. Yields up just a touch. By a couple of basis points, call it 3 basis points higher on a 10-year, 4.0416% on a 10-year. We talked a lot about that upside surprise on CPI to Europe. The euro's weaker, euro-dollar negative 1/3% at 99.32. Brammer, you've talked about it a few times this morning already. That data out of China overnight, the PMI's in the 40s. Crude at 86.25. We're down by 1.9%.
And how much really is China the story behind crude? And how much does that really lead to the even more ambiguity of what happens next year when so much of this is driven by zero COVID?
We heard from China, from Vitol, rather, on China moments ago with Manus Cranny, unlikely to see demand rebound in the second half of 23. Is that good or bad? If you're in the United States right now, is that good or bad?
It's good in terms of not necessarily leading to an oil price spike. It's bad when it comes to the prospect of some of the supply chain disruptions that have allowed prices to remain high in other areas of the economy, because it is hard to see how those really ease up with these still constraints in China.
Sourcing you a flashlight right now. We're going to make it happen. Lisa Hornby.
If you get me one, I will do it.
Is standing by, the head of US multi-sector fixed income at Schroders. Lisa, the Federal Reserve on Wednesday, all this chat about a step down. What are you and the team thinking about when you go into this November meeting?
Well, I don't see any reason for them to commit to downshifting on Wednesday. I think that they will let us know that they're considering it. But we have, as you said, John, 2 CPI prints between Wednesday and the December meeting. So what's the point in saying, here's what we're going to do, it's time to downshift? I think they're going to say, hey, look, if we see inflation moderating to some degree, we're open to it. We realize we've hiked a lot. It's going to take some time for this policy, this tighter policy, to actually have an effect. But as you said, the central banks have been wrong before, and they've said they're going to back off a bit, and then they end up having to kind of go full throttle. So I just don't see why they pre-commit quite yet. They don't have much to point to in the way of inflation moderating here.
In the meantime, people are looking long-term, and they're trying to get a better sense of long-term, since short-term is so difficult to project. And Brian Weinstein of Morgan Stanley earlier this morning saying that he likes long-dated treasuries because regardless of what they're going to do, it's going to slow growth and slow inflation over the longer term to make 4% yield on a 10-year treasury attractive. Do you agree?
I think there's a lot of merit to that. I think it depends on your time horizon. If you're a long-term investor now, certainly. Will you have a better entry point tactically between now and the next 6 months? Probably. But again, it depends on your time horizon on this.
Nice feature over the weekend in the Wall Street Journal. I think they had about 5 or 6 investors being interviewed about 2023 and the opportunities. This jumped out from Rick Reeder, Bramo. He said, I'm more excited going into 2023 than I've been in a really long time. You hear that a lot from the fixed income team, don't you?
Yeah, a lot.
You hear that a lot. I really do.
Okay. I hear that also because I lived through the era of people railing against zero rates, complaining. We're not getting anything. This is ridiculous. It doesn't make any sense. Now they're getting 9% average yields on things that actually look better because these companies have preserved cash.
For those people who've been sitting in cash complaining about low rates, I haven't heard enough from them about saying, yes, we're going to take some opportunities here. Lisa, does that resonate with you, what Rick Reeder said over the weekend? I'm more excited going into 2023 than I've been in a really long time.
It absolutely does. I mean, that was basically the title of our market paper as well. And, it's to Lisa's point, you don't even need to go to high yield to get interesting yields. I mean, HSBC came with a bond deal last week, north of 7%. It's a 4-year piece of paper. I mean, I think you're going to be paid. You're going to be well compensated for that. Again, time horizon matters, but over the next 4 years, 28% return, I think that's going to be a good investment. And you're just sticking in the investment grade market there.
Lisa, how has business changed then? Can you walk us through that just over the last 6 months? Do you get the sense that people see the world the way you see the world in fixed income going into next year? There's more interest from people that would typically be allocated to equities or somewhere else?
Yeah, I absolutely do. So I've been to I've presented at a few conferences, and the interest in fixed income now is much higher. It's palpable. People are excited about it. I think there's still a little bit of nerves, right? It feels a bit like catching a falling knife here, and so there's a bit of a, we want to allocate, but not quite yet. So I do feel like there's the risk, and we've had this a couple of times this year, where you get a bit of a rally, and then all of a sudden you get a lurch, even tighter, because everybody realized, this is it. We passed the peak. We need to get in, and then it's been in past the last year. It's been kind of false starts, but I do think that could be the template. You know, everybody is sort of waiting, sitting on their hands a bit, but they want to get invested, but we're not quite there yet. So when we do, it could be fairly sharp. But I think there's a lot of interest. I mean, when you compare fixed income to private markets, when you compare them to other public markets, I mean, fixed income has corrected a lot. I mean, my
Just
favorite
massive.
stat right now is it's credit of Deutsche Bank, but they basically have the Treasury index going back to 1788, and I believe this was the worst return since that period. So it just gives you some context for, we use the word unprecedented a lot in markets, but I think that's truly unprecedented.
Truly is. Lisa, thank you. Lisa Hornby there.
Thank you.
Schroders, thank you very much. I just hear that so many times, Bramo, at the moment. So many times when it comes to fixed income.
Well, just to put this into perspective, when she's talking about an unprecedented decline, I just looked at the Bloomberg U.S. Corporate Total Return Index.
Sure.
It's down more than 19% so far this year. That is the worst year on record, if it continues at this level, going back in records to 1973. So to give you a sense of just how much pain has been absorbed into this market, people are now saying, okay, it's taken a lot. We kind of like this. The sort of hesitance to her, which is really amusing.
It sounds like you're hesitant to say it as well. I'll say this is not a judgment about what we can achieve or where we're going, more an observation. There is some good news if we can, actually settle down. I just think if risk-free can end up at 4%, it just changes markets completely in a positive way. It brings discipline back. You stop this nonsense in equities.
I would agree.
This is what people have been complaining about for a decade.
You got it.
Plus.
Here you go.
Bramo, what do you write about if that's the case now? 10 years of columns.
I don't know. It's a good question. I can just have to be like, you've said I've looked more constructive recently. Well, this is the reason why.
You've certainly changed. There's no flashlight or torch, whatever you guys call it. All
right.
Greg Valliere is going to join us shortly at AGF.
Hopefully.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Brazil, it's a dramatic comeback for former President Luiz Inácio Lula da Silva. The left-wing politician has won the presidential election, narrowly defeating incumbent Jair Bolsonaro. 3 years ago, Lula was in a jail cell on corruption charges. Bolsonaro has neither conceded the race nor commented on the results. His reaction will be closely watched by investors. Ships loaded with grain are sailing from Ukraine, despite Russia's announcement that it was withdrawing from an agreement to keep seaborne exports flowing. Both the United Nations and Turkey are working to salvage the deal. Ukraine is one of the world's biggest suppliers of wheat, corn, and vegetable oil. Meanwhile, Russia launched a massive wave of missile attacks across Ukraine. The capital, Kyiv, was one of the cities that was hit. In South Korea, the government has opened an investigation into one of the country's deadliest incidents in years. At least 154 people were killed when a crowd squeezed into a narrow alley during Halloween festivities. Reports are that some people began to fall, causing others to tumble and pile onto one another. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
Right now, as you know, in the Senate, it's a 50-50 tie. In the House, Democrats have a very small majority. The vote right here in this district could determine which party controls the U.S. House of Representatives.
This is serious stuff, of course, a week away from the midterms, but at the back of this studio, it's all dark. There's not much lighting, and all I can see right now is a floor manager in a skeleton onesie.
Yeah.
I'm not sure even that the cameraman can pick up Joel wearing that.
Let's see if we can see.
Can we pick that up?
Can we do this?
Maybe we
Joel?
can pick that up. Just about.
That's fantastic.
Joel, I can't even see your head.
I know.
Just see the outline of a skeleton onesie. Anyway.
Happy Halloween.
Did you find that flashlight? That torch?
No, I didn't, and you didn't bring me
to
one.
Do bearish pieces. Do you know how good that would work on digital? Just like weekly moments with Bramo. Bramo's World, 60-second clips of you just in a dark room with a torch.
Yeah, exactly.
Just telling everyone how bad things are going to be.
Really? Are we doing this? Are we doing this?
No, I can do the market as well if you want.
Let's do the market.
Futures down 0.5% on the S&P. Is Happy Halloween a thing? Do you say that to people?
Yes, that's what you say.
Happy Halloween?
Yes.
Okay.
Just try to enjoy it.
Like year 7.
You're not
it's
really
like year
even
7
trying.
going into year 8 or something of being here, and I'm still trying to work this out. Yields up a couple of basis points, up 2 basis points to just north of 4% in the FX market. Euro dollar down 1/3 of 1%, 99.30. I actually think bonfire night in the UK is more controversial, that we teach kids that it's okay to burn historical figures on a stake. I think that's bizarre. Well, I find that really bizarre.
Who you just dress
Guy Fawkes night. I find that just ridiculous.
I couldn't disagree. I think it's also, in the U.S., you just, dress up like them.
Dress
and
up
walk
like
around and different
skeletons and whatever you want.
Public figures.
As public figures?
Yeah.
Did you see at Spirit Halloween you can get like Federal Reserve figures now? Chairman
of course.
Powell.
You
can put an order in for the Guard and Bailey.
All right, you want to do that?
I was going to sort that out. I don't know if you can actually do that at Spirit Halloween or not. Greg Valliere joins us now, Chief US Policy Strategist at HGF Investments. Greg, let's talk about energy, and that's been a big problem for this White House through this year. How is that playing in the midterms, the lack of a coherent energy strategy in the minds of so many people, Greg?
I think it's playing really poorly. A great editorial in the Wall Street Journal, I think it was this morning, all the days start to blur, but talking about how dysfunctional this energy policy has been. I mean, Joe Biden is complaining about prices, but in reality, one of the reasons prices have gone up is because of his policies.
Wait, can you elaborate on that, Greg? Because a lot of people think that his policies have been to unleash the SPR on the energy market, on the gasoline market, and that's brought down prices. What's the other side of the story?
Well, the other side, Lisa, I think, is how adversarial the White House has been, starting within days of his inauguration when he killed the Keystone Pipeline. And then he's gone from there, really beating on fossil fuels, coal, oil, natural gas, and saying that renewables is the way to go. I think renewables will play a major role for the rest of this decade. But right now, we need fossil fuels.
Okay, so that's the case. At the same time, perhaps it's just the coherence in the message from this administration, because they have actually confirmed that kind of view and said we need to encourage investment by some of the oil majors. Where could they be more consistent, right? What could be the message that could read through better that perhaps the Republicans are giving, in your view?
Well, I'd say probably regulatory policy, which has been quite restrictive. I think the industry senses a regulatory policy that's quite harsh, and therefore the industry is not doing much drilling or refining or shipping.
Greg, if they can keep hold of the House and the Senate, what do you think this administration would like to do next? What do you expect to happen?
Yeah, it's a good question, John. I think that because both sides are so bitterly divided, we have to lower our expectations for much. But I do think there's a chance they'll talk about immigration. Everywhere I go around the country, I hear the same refrain. We don't have enough cooks, waiters, waitresses, carpenters, whatever. And I do think more legal immigration is really would be very beneficial. And I think both parties might agree on that.
Greg, in the meantime, a lot of people are thinking that it's going to be gridlock, and markets like gridlock, and that seems to be the feeling right now. Is this going to be gridlock that's good for markets?
Yeah, I think so. I think that there's not going to be anything radical, certainly nothing new on taxes, capital gains, the estate tax, the top rate. I think all of that stuff gets frozen for at least 2 more years, and that kind of predictability is a good story for the markets.
What does that do to our alliances with other nations? And I think about some of the potential for restricted exports of natural gas, of diesel, especially in light of some of the up in price that we've seen recently in both of those categories. How much could that really create some long-standing fissures in classic alliances?
It could. You can't rule it out. I would say, though, the biggest fear that I would have in terms of fissures is Ukraine policy. We're starting to see a lot of ads on TV in the last couple of weeks talking about why are we spending this kind of money on Ukraine? We got problems right here. If there starts to become a perception in Western Europe and in Russia and Ukraine that the U.S. is losing some of its resolve on Ukraine, that's a big deal and a very negative story.
Well, Greg, the prospect of any kind of trade restrictions on energy products out of the United States would only exacerbate that in places like Europe. Yep. Greg, that trial balloon has been floated a few times this year. They haven't gone forward with it. Is that what's holding them back? I guess it is. What would push them forward? What would make them go through with a policy like that?
Well, I think what would push them forward would be a sense of the U.S. economy is starting to weaken sharply. I don't see it yet. The data looks pretty good. But if at some point next year the U.S. economy is starting to slump, then I think there'll be a serious debate over how much we're doing for Ukraine. And the Republicans may lead a fight to give them a lot less.
Hey, Greg, thank you. Appreciate your time. Greg, no doubt we'll catch up before next week. Greg Valliere there of AGF Investments. Bramo, if they go forward with that, can you imagine how controversial that would be?
Oh, it would be massive. I mean, can you imagine any kind of trust between the United Kingdom, between the European Union and the United States? If the United States says, look, well, we're facing pretty high prices too, and it's not expedient politically, so we're not going to export to you, even though you might be struggling with that. That's not going to fly. But, oh yeah, keep the Ukrainian policy as it is. And that's why I wonder if Vladimir Putin and the Western nations are in a race right now for how quickly the pain can hurt the other more than themselves to get some sort of win.
This White House has done a good job of keeping its allies on side, speaking from the same script. Every single country across Europe doing the same thing, with the exception of maybe places like Hungary. But for the most part, they've done a pretty good job of doing that. If they went forward with something as divisive as that, I just think that changes everything, doesn't it? And that's probably why they've held back from doing it.
It would be a game changer, not just with Russia, but also with China, because what kind of alliance can you have if you don't back your allies from an economic perspective? That's going to be a major issue.
That skeleton's getting closer.
He's wrapping
close,
us.
Joe. It's just
He's
in the corner
us,
of my eye.
Be quiet.
The corner of my eye. Just like, gets a break. Futures down 0.5%. Going to
look
break.
Like me.
This is Bloomberg. 60 minutes away from the opening bell, equities looking like this after a really decent week of gains on the S&P 500, despite the fact we had some pretty terrible earnings from some of tech's major players. Futures down by 0.5% on the S&P, down by about 21 points. Yields higher by 3 or 4 basis points on a 10-year, just north of 4%, 4.0499. You can call that 4.05 if you like. Euro dollar 99.26. We are negative 0.4%. CPI data out of the Eurozone earlier, 10.7%. Ugly stuff. Crude's down 2%, $86.13. We had the PMIs out of Europe last week in the 40s. Out of China coming into this week in the 40s. PMIs in America, S&P global PMIs often get ignored. We look to the ISM. So the ISM comes out tomorrow, Bramo. You wonder whether that confirms some of the doom and gloom you see in Europe and, for that matter, in China as well.
Yeah, and if you don't see that, how much is that going to become a problem for some of these central banks that are going to keep hiking into that? I'm a little distracted right now because I'm looking at some of these headlines regarding OPEC's latest report, and this is the thing. Demand is going to keep increasing. That's what they're saying. And this is sort of the cudgel with some of the transition that people are talking about that we were just talking about with Greg Valliere. How do you offset the need for oil now and in the next 5 years, et cetera, when you don't have oil majors willing to really invest and you don't have policies that really want to support that given the transition?
The transition away from oil is, quote, potentially dangerous. That's their line. We've heard that a lot this year.
So how much is this politically pushing towards some of the fossil fuel companies? How much is this revenge of the real economy? And how much is this that we have to bridge the gap between now and then is a little further off than some people thought, then being a future where you can really rely much more on renewable energies and not as much on fossil fuels.
I mentioned that quote from Prince Abdulaziz bin Salman at the investor conference in Riyadh last week. And of course, the irony when I read this quote, the irony won't be lost on any of you, I'm sure. People are depleting their emergency stocks, used it as a mechanism to manipulate markets while its profound purpose was to mitigate shortage of supply. I said this earlier, but I'll say it again if you're just tuning in. There's 2 points there. One on manipulating markets. I'm sure you've got your own view on OPEC manipulating markets. But the second point, Lisa, the purpose of some of these inventories, like the stockpiles over at the SPR, the purpose was to mitigate a shortage of supply. Have we seen an emergency in the oil market? I remember asking this question to Francisco Blanch of Bank of America a number of weeks ago, who basically said, no, we haven't had a crisis in the oil market yet. And if we do have one next year, we're a whole lot more vulnerable potentially now because of what we've done this year.
And that's what a lot of people are saying. And I think that everyone pretty much is in agreement here that this was for the express purpose of bringing down prices and not because there was an actual shortage of people not being able to get gasoline into their cars.
It just make me smile when someone from OPEC talks about manipulating markets, though. I mean, like,
it's a little rich.
Come on. Vincent Reinhardt joins us now, Chief Economist at Dreyfus and Mellon. Vincent, fantastic to catch up with you, sir. Federal Reserve decision on Wednesday. I'm sure you're frustrated by the conversation at the moment, but you know the conversation of the moment. It's about this step down in interest rate hikes. How you expected the chairman to navigate these conversations in the news conference?
So if he first, they'll deliver 75 basis points because that's what they've said, and they haven't said anything different. With regard to the hard part, 5th December and 2023, he doesn't really have to say much. They don't have a summary of economic projections dot plot this meeting. The last one said there'd be a cumulative 125 basis point tightening over the last 2 meetings of the year. If they do 75 basis points on Wednesday, everybody will do the math, and that says 50 basis points in December. That's the step down. And even the language of the FOMC statement is consistent with an outsized move, i.e. something bigger than 25. 50 is bigger than 25. So his safest bet is to keep it pretty low key. Steady on course, because on course is 75, then 50, and then talk about 2023 and 2023.
Stocks are up almost 9% on the S&P in October. Of course, that's just one input into broader financial conditions. But Vincent, do you think we've seen a sufficient easing of financial conditions that requires some kind of direct response from this chairman to lean back into that?
This is a mini replay of July and August running up into Jackson Hole, where equity investors in particular got ahead of themselves, thought there would be a virtuous decline in inflation. If there was a recession, it would be painless, and that the Fed wouldn't raise rates very much and turn them around really quickly. Jackson Hole disabused the market participants of that notion. I think Jay Powell will have to do a little bit of that at this meeting, but really it will be in December with a new summary of economic projections. I think the message for them to convey is the same in Jackson Hole and the same they've been repeating. They're going to raise the funds rate. They understand it involves pain, and they're going to keep it there for a while. It's the plateauing that really will convey the important message. They got to get the funds rate into an area which they're confident that it involves policy restraint, and then it's a matter of holding it for long enough. Once equity investors get that message, you won't see the easing of financial conditions of the last week.
Vincent, in the meantime, you have this point in your notes that's really scary to me, to be completely honest. You write, tightening of the monetary stance abroad and the weakening global economic outlook is why we think the FOMC will stop short of firming enough to return inflation to the goal within the next 2 years. Are you basically saying that we are bound to be stuck with much higher inflation for longer because the Fed is worried about breaking something not just in the U.S., but globally?
Up to now, we've been talking about 2022. I think that's the discussion for late 2023 into 2024. And my basic concern is everybody knows what to do about monetary policy when inflation is so high. That's why there's not a lot of doubt about what the ECB will do later in the week. 2 digits on your inflation rate is a bad look. When inflation is this high, when you're that far above goal, you know you got to firm. However, next year inflation will be lower, the unemployment rate will be higher, our major trading partners will be in recession, and the Federal Reserve officials will have a much harder time balancing across their dual objectives, maximum employment and stable prices. And the temptation to reverse course will be pretty compelling. And besides, if inflation's falling and they have a forecast that more plausibly implies inflation getting down to a round goal in a year or 2 or 3, might they not stop short? Paul Volcker got cold feet the first time round, remember that. Paul Volcker stopped short of 2%. But the second time round.
But Vincent, does this mean that we're going to be doomed to that stop, start that Mohamed El-Erian is talking about, that's going to leave us with a decade of inflation that will not get back down to 2%?
So 2 points. One is we got an old look for monetary policy now, right? The Fed is talking about outcome-based, not outlook-based policy. They're responding to events, not trying to lead them. This isn't forward-looking monetary policy. Well, that sounds 1970-ish already. The second part is, yeah, I think inflation will prevail above Fed goal. I don't think that far above goal. We are not talking about 5 or 6 or 7% inflation in 2024. It's rather something that's in the low 3s and the high 2s, something that the Fed could plausibly say, well, we're only one recession away from price stability. Let's opportunistically wait for disinflation down the road. Bad for fixed income investors, bad for markets. If 2% is your goal, you should get there. They're just going to say, let's take our time getting there.
That makes it sound very simple when you put it like that, don't you? We're just one recession away from price stability.
It doesn't sound simple at all.
Makes it sound easy.
It's also painful because there are people involved in those, by the way.
In a massive way. That is the painful point at the moment. Vincent, thank you. Vincent Reinhardt there of Dreyfus and Mellon, as always, just absolutely brilliant. And we've gone back and forth on this through this morning and many times over the last couple of months. I still think that's the major challenge in the news conference. You're doing this within a week of the midterms, and you've got the Democrats pushing back. And some of the points they're making are spot on. We haven't seen a sufficient explanation from this particular institution to suggest as to why higher unemployment is a price worth paying to get inflation down. And I keep going back to that question. I think they've acknowledged it in their forecast that unemployment needs to go up to get inflation back down. They haven't communicated why that is a price worth paying.
Except that you are seeing wage gains. We saw that on Friday with the employment cost index, and you keep seeing that, and they're saying, how do we get wages to stop rising so quickly, which also is a difficult thing to really pass through. If you talk about the fact that those wages are not keeping pace with the cost of living, you're correct. This is a difficult moment. They're relying on history at a time when history perhaps is not the best guide for a now new inflationary environment in the face of global conflict and deglobalization. This is new.
Are you coming to my Halloween party later?
Oh, it's going to be a rich
Tom's hosting.
Oh, yeah, is that right? What's he going?
He's been decorating the living room at our place.
Yeah, at your place that you share together?
Yeah.
Okay. That sounds like also very close to the truth.
Yeah. No, at our place.
What's your favorite kind of candy?
My favorite candy? You think I eat candy? Come on.
Sounds like
Grandma.
A great Halloween party. That's all I can say.
Everyone's having protein shakes.
Oh, that's great.
And egg white omelets.
Oh, egg white omelets for Halloween.
Omelets.
You just basically, the kids come to your door.
You see me celebrating Halloween?
No, not in the slightest. That's why I'm saying.
Give me a
candy. Can you imagine?
Aaron Kennan, co-founder and CEO
Egg white omelets. Are
of
you
Clear
that
Harbour
person?
Asset Management. Yes.
And when people knock on your door, do you hand them an apple?
Slices of fruit.
Oh, for God's sake.
Slices of fruit.
You're that guy.
As our producer just said, nature's candy.
Oh, dear Lord.
From New York City.
You're going to get hate mail.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Brazil, the results of the presidential election signal a change in direction for Latin America's largest economy. Luiz Inácio Lula da Silva was elected in a dramatic comeback for the left-wing politician. 3 years ago, he was in a jail cell on corruption charges. Lula narrowly defeated incumbent Jair Bolsonaro, who has neither conceded nor commented on the results. His reaction will be closely watched by investors. Today, there's a showdown at the U.S. Supreme Court over affirmative action. Justices will hear arguments on admissions policies at Harvard and the University of North Carolina. The schools are battling an interest group that wants to overturn precedents that let colleges consider race when they choose students. The CEO of Barclays says the lender's investment banking operation is critical to its success. C.S. Venkatakrishnan, he spoke with Bloomberg in his first television interview since taking the job a year ago.
The investment bank has been what has kept Barclays flourishing and quite apart from many of our competitors in the fact that, we performed extremely well during COVID. We are able to have a more diversified business model.
Last week, Credit Suisse confirmed it is looking to downsize its own troubled investment bank after multiple losses. And more headwinds for the economy in the UK. British consumers and businesses have cut back on borrowing after a jump in interest rates. According to the Bank of England, new mortgage approvals fell 10% last month. That's the sharpest pace since February of 2021. Credit card borrowing and loans taken out by businesses also declined. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What we're seeing in terms of the dollar is an unprecedented run and scarcity. And scarcity becomes problematic when we think about what's going on in Europe, in Japan. And I think that's going to be a big story.
That was Ian Lingen, head of U.S. rate strategy at BMO Capital Markets. We are talking about Halloween today, and one viewer had this comment. Inflation humor on a day of Halloween, suggesting that I dress up as transitory inflation, arrive at the party as inflation, and then proceed to leave early or simply stay and refuse to go. Anyway, we will get into that. Right now, we are looking at markets that are a little bit off after last week's gains, although nothing pretty dramatic considering the declines that we saw with respect to big tech. The S&P down about 0.6%, 38.89. I do think it's interesting to see euro weakness on the heels of an inflation report surprising to the upside. What happens to the euro if you do get an ECB that continues to tighten rates? Is that good or is that bad for a euro? Right now, this is very much politics season, not only in the United States, but around the world. We have elections going on globally, including just in Brazil, a pivotal election at a time of a populist, Bolsonaro, with a rival and former politician, former head of the country, Lula, who actually did come to power. Bloomberg Surveillance has been in Sao Paulo covering all of this, and Damian Sassower, who always covers all things emerging markets here for Bloomberg Intelligence, here with us as well. Sherry, I want to start with you to talk about the emotion, the importance of Lula's victory, and how controversial it has been in the aftermath, given how close the victory was.
It's really been a historic comeback for this politician, two-term president in the 2000s, now back in power, incoming president Luiz Inácio Lula da Silva. We still have yet to hear from incumbent President Bolsonaro. And of course, this was the narrowest margin of victory in a presidential election in Brazil in 40 years since Brazil returned to democracy. So we are expecting to hear from Bolsonaro at some point. We heard that his presidential convoy left his residential palace in Brasilia earlier today, but he refused to make any comments. The question right now for everyone, including investors, of course, will he concede defeat? Several times in the past, is cast doubt on electoral authority, so there were fears that he might not go quietly.
How much social disruption, Sherry, has there been on the heels of this, considering that Bolsonaro was talking about he'd either win, he'd die or get jailed, and those are basically the only options in the post-election aftermath?
Yeah, we have seen, of course, what has been, I haven't really heard your question very well because there has been interference, but I'm assuming you're talking about the post-election results, what happens next. And this is what we're gathering right now. Perhaps not a lot of violence out there. We saw a little bit of violent incidents during the campaign, especially from Bolsonaro's allies that actually hurt his chances. Bolsonaro's polls were actually down this week when we saw more of those incidents. But perhaps there is a little bit more optimism and relief in the markets as well, given that we haven't seen any big instances of violence during the election count. Last night, we were out on the iconic Avenida Paulista, and it was a lot of joy and excitement by Lula supporters, expecting really new hope, new optimism for the country. Markets still down. The Brazilian real was down about 1.9% paired back. Those declines against the U.S. dollar. Stock futures are also down. But still not a huge negative reaction. In fact, Brazilian-related assets in Asia traded in the positive.
Thank you so much, Sherian, down in Sao Paulo. Damian Sassower here with us as well. And I'm curious from your perspective, the importance of this, both from the market's perspective, after the real actually has surged, I believe, the most of any currency so far this year versus the dollar, but also from a larger political takeaway for the emerging market complex.
Well, I think you hit on the right point. I mean, the real is up 5.3% year to date. It's one of only three major emerging and developed market currencies that are up versus the dollar this year. What it means is that Brazilian government bonds have had a fantastic year. They're up double digits. The only other emerging market, forget about it, developed and emerging market, local government debt market that's up year to date is that of Turkey. So that just tells you everything you really need to know. But what we're waiting for here is obviously Bolsonaro. I mean, but the fact that the prosecutor general and the president of the Senate have already come out and validated Lula's win, as well as the presidents of the United States, Canada, and I believe Norway, it says a lot. And I think Bolsonaro's silence is deafening on that front. We're waiting to see his cabinet selections. We're waiting to see Henrique Meirelles, whether or not he's the former BCB governor, he's the former president and chief operating officer of Bank Boston here in the U.S. through the 80s. He's the pick that most are expecting that would be good for markets.
A lot of people are looking to the Lula win as something of stability, of going back to the complex of a world order that's sort of a throwback and not the populist kind of let's go it alone and prioritize the economy over the rainforest or other things. I'm curious from your perspective whether the tighter interest rate sensitive market is actually pushing people away from some of the more populist views that were fueled by freer money.
Yeah, well, I think it's the structural logistics of the judicial system, the Brazilian presidential executive judicial system right now. Just the fact that it's a divided Congress. You know, Geraldo Alckmin, who's Lula's running mate, lost in the election to Bolsonaro. He's right down the middle. He's right down the center, and he's going to have to govern from the center in order to bring the country together, bring the economy together. I mean, if you look at the results, it's basically the North versus the South, right? The southern regions have all voted in favor of Bolsonaro. I'm talking Sao Paulo, I'm talking Rio de Janeiro, and the whole Northeast has voted in favor of the Workers' Party, in favor of Lula. So it's a very divided country right now, and it's going to be very difficult to govern and to kind of impose some of his policies on the climate, deforestation in the Amazon, for example, on women rights, on LGBTQ rights, on just to kind of go back after 700,000 deaths during the virus. That's basically what happened in Brazil, just a massive amount. And the handling by Bolsonaro of the virus is something that resonates in a lot of people's minds.
Sherian, who's been doing tremendous work down in Sao Paulo, talked a little bit about the fears of social unrest, of some of the potential violence. How do you look towards some of the social unrest that we've seen or the potential for it in certain regions and parlay that into a market view, parlay that into understanding the impact that it will have on the economy?
Well, you look at the populist pivot throughout LATAM, Peru, Chile. You know, they've obviously gone more in the direction of what Brazil's been doing right now, just electing a populist president into power. But they haven't really been able to govern from a populist perspective yet. Most of those countries, because of everything you're saying, because of the world, the macro risk, the structural kind of what's going on in each country. And I think Brazil's going to be confronted with much the same thing. You know, a lot of their markets are going to be dictated by the Fed, by the United States government, by what happens here in terms of inflation and abroad. And I think you're seeing that in terms of swap rates this morning. Swap rates are a bit wider just to account for the increased sovereign risk. But by and large, the market is expecting some really significant rate cuts as you move forward into 2023, along with Chile and the rest of the world, because, look, things are getting tight there and economic activity is deteriorating quite considerably.
And they front-loaded it. How high are the rates right now?
Oh my God, 13 and change, I think, 13.75.
There you go.
Yeah.
It's far cry from the 3 and change that
Yeah,
we
that
have
we
right
had,
now.
yeah.
Damian Sassower, thank you so much, as always, for the context at a pivotal moment for Brazil. And people are taking some large messages from this as we go around the world to a whole host of other elections as well. Coming up on Balance of Power on Bloomberg TV and Radio, Austin Goolsbee, strategic partner and 32 Advisors and former chair of the Council of Economic Advisors. That is coming up. Looking at the markets, you are seeing yields slightly higher. You are seeing stocks slightly lower. It could all change. It's a huge week coming up, with the peak being the FOMC meeting and the rate decision on Wednesday. This is Bloomberg.